Open my video. So my video and audio both are visible and audible. Yes. Okay, great. So how are you all? How's your Sunday going? So I know for a chartered student, whether you are doing a when you are doing a professional course, so Sunday is no Sunday. There is no Saturday, Sunday. It's all classes. It's all working, right? Well, it's for the your own good, yeah, right? So you are preparing for something great, so you have to give your effort. So I think I see less student as compared to yesterday, but no worries. I'll be starting with the revision first, and then just giving 5 to 10 minutes on the revision, and then we'll be starting the class so that in the meantime any student can join, so they do not miss out on anything. Okay, so I'm just sharing my screen. So let me know if it's visible, and we are starting with the revision right now. Okay, and let me know in case anyone has any doubt. I'll be starting with the revision. So yesterday we started with the discussing about audit and assurance, like what is the subject about and what kind of sources you would be using and what is the percentage of marking based on MCQ and the case study base, right? And I hope you would be using the ACCA Learning Hub, especially the CV practice platform that I cannot emphasize more. The CV practice platform is your tool, your key tool to passing the exam, and technical article, of course. Okay, so I hope this was clear to all of you. And then I just skip this the syllabus para for a moment. We'll be covering after the after today we'll be covering this as well. And then we started our chapter number 1, the introduction to audit and assurance, where we started discussing about what is assurance, which we now after the yesterday's class, I hope we all understand that assurance is nothing but verifying the information, whether financial or non-financial, and giving an intended user of that information some comfort, some confidence. I hope now we understand the definition and what are the three parties to practitioner, intended user, and responsible party. So practitioner would be the expert who would be verifying or checking the information and providing the opinion. Intended user, like in our builder case, like the construction building case, we understood that the buyer of the property would be intended user, and then there would be responsible party, and that would be a builder. And then we went on discussing this example of construction of building. I hope you guys remember and you got the clarity about the independence and expertise professional practitioner provides. Then we went on and discussing the elements of assurance. And once you understand what is assurance, so it basically becomes very easy. So we discussed like there are 5 criteria, and you can, understand this by this crest mnemonic just for remembering, like C4 criteria, which basically means best practices, which based on you would be, evaluating the subject matter. The report would be, you providing finally the report after verifying all the information, and that report will be addressed to the intended user. Evidences, basically, as I told you, evidences is something that a professional practitioner must obtain and must document them. We'll be talking the importance of document throughout the audit syllabus, like what is the importance of documentation of evidence. Because tomorrow, if let's say a case is filed against the practitioner that he issued a wrong opinion, so he or she can show the evidences that in good faith that whatever they have done, they did as per the best practice available. And how they can prove it? By showing the evidences they have acquired. So evidences is a kind of a safeguard for you to protect yourself and as well as verifying the information. So in case of a building construction, I hope you guys remember the evidences would be certificate of in civil engineer or basically fire department approval, something like that. That helps ensure that building is properly constructed. And subject matter is building in this example, and three-party relationship we, I hope, have full clarity on. And then we just gave this one simple activity about like donation or basically house construction, which we discussed in the class. And then basically we gave some examples of the assurance engagement, though I did not discuss them in detail because you would be getting better clarity once we cover these separate chapters of the class. And then when you come back, so you'll be able to understand, like I made you understand about the going concern, the importance of going concern for an entity. And sometimes this happens that professional practitioners are asked to evaluate the going concern of an entity. And by going concern, I mean that entity's ability to continue its operation in the future. Okay, and we'll be looking at the accounting definition, but for the timing we can say that going concern has an impact on balance sheet. I showed you, paper one balance sheet where the non-current assets and current assets basically does not remain in case going concern is not affected. And that way the users of the information would decide whether to deal with an organization or not. So that impacts economic decision, right? If you remember that. And basically entities first half results, year of result, basically interim audit, so that can also be part of assurance engagement, though interim audit is a part of overall audit, which we'll be covering in the later chapters. Cash flow forecast, like you are forecasting the future cash flows, projecting, like some projects happen that you want to show it to the bankers. Let's say that company is interested in making a project, and then it's forecasting its cash flow so that it will show to the bank and get a loan approval for the project. So this way basically bank wants that cash flow forecast to be verified by a professional practitioner. So this is basically for that engagement. And this part, that review of internal control, I'm not sure like how many of you understand this term internal control, but it is one of the most important term of this syllabus. Internal control, basically entity system, and we'll be covering this in the corporate governance chapter. And chapter number 9, I think chapter number 9 is test of control and system control, I think. So basically internal control is something that entity helps entity uses to ensure that its business is running smoothly. So we'll be learning the importance of internal control and what its significance is for the auditor. Okay, so please understand, when we are learning about the management and learning about the entity, this is something that I want you to pay attention to. When we are learning about the management or learning about the entity, our purpose would be to understand the significance on the audit. Okay, let's say we are going to learn about entities business, we are going to learn about entities way of conducting the operations, or basically how entity ensures that there's enough security, there's proper regulation. So we will understand, and we will also try to identify whether there is any weakness in those systems. But our purpose of understanding is only to understand its importance on audit. Okay, so whatever we are going to understand here is for the purpose of audit. So please, when I will be teaching you, and this is one of the most common thing that students make, they try to become the management themselves. You are not supposed to be the management. Remember in the last class I very briefly told you about, like, you are in no position to advise management or directors how to run the business, because you are not the directors, you are the auditors, you are the professional practitioners. So you are not advising anybody how to run their business. You are just verifying information that they have provided in their financial statement, that whatever, whether they have done a great business or a bad business, so they have reported in their financial statement. So we are just verifying that. So whatever we will learn in the audit, we will learn from the point of view of the auditor. Okay, I hope this basically provides a clarity. Internal auditor, yeah, yes, that will be, we will be covering, but I'll not be covering internal auditor now. Internal auditor is a very big topic. Okay, and then we understood after, what are the benefits of assurance benefit, basically reliability, credibility. You basically enhance the users in confidence that with what decision then they can make. And then management bias. Management bias, basically I told you that management does not manipulate the records, right? I hope we understand this now. And then this is a term which I try to emphasize, try to draw your attention to, that there is a modified opinion. And modified opinion is a very very important thing when an auditor issues a modified opinion. And if you see this picture, if you see this picture and you can see this man is getting scared. So this is the kind of attitude a management, a company, an organization gets if auditor issues a modified opinion, because they are scared. Because now what auditor is saying by issuing a modified opinion, that see, we have checked and according to us not everything is correct. So it draws attention of the user. Okay, so this entity is not giving 100% information, or not everything is correct in the statements. So that's why user can make better judgment. If you remember, I have given you example of two companies having one company having a pending case, but they did not show it in their financial statement value, right? And other than that, I think we then later on discuss about the assurance and the audit. Like assurance is a bigger scope. It basically covers non-financial aspect as well. And I for the non-financial aspect, I gave you an example of law and compliances, and also going concern would be a good example of assurance aspect. And basically, we understood that audit is a subset of the assurance. So audit comes out of the assurance piece, and audit is for the financial statement. And when we talk about audit, audit is a reasonable assurance. So we later on discuss about the uh, about like what is reasonable and limited. But also if you remember, I discussed very briefly about the general purpose financial statement, and they are used by multiple users like shareholders, banks, employees, suppliers. So different people use this general purpose financial statement. And as an audit, generally we do the audit of financial statement of a company or an organization, basically company or basically government organization, non-profit organization. So we'll be learning today, like if we are able to cover the chapter number 2, so we'll be learning like who is supposed to do the audit and who's not. Okay. And then we discussed like, okay, sorry, we were discussing the stakeholder here. Okay, we were discussing website. Okay, stakeholder website, like how general purpose financial statement. We discussed this going concern. And then here we basically discussed yes, law or responsible. Okay, I don't think that I need to. Okay, this part is basically remaining. As I told you, this is basically the complete syllabus, and I'll be, trying to touch upon the audit process here. Today, I'll be trying to touch upon the audit process. Audit process is a very detailed concept, basically your entire syllabus. So I'll be trying to give you a very quick summary so that you can understand what does this in lines means. Okay. And other than that, I think we covered the reasonable and limited assurance. So please remember, reasonable assurance is basically positive assurance. Limited assurance is a negative assurance. Since limited assurance is a negative assurance, so it's always a less level of assurance, whereas reasonable assurance is a positive assurance. That's why it's a high level of assurance. What I mean by that, when you give a negative assurance, that means you are saying I did not find anything wrong. So that means what you're saying is you are not 100% sure about the entity, but you could not find anything wrong. Okay. Whereas in reasonable assurance, you basically say that whatever based on my checking, I have done all my checking, and I can say, yeah, this entity is, is actually true and fair, is actually, representing itself correctly. So it's a very big statement compared to you saying, okay, I did not find anything wrong. So there could be possibility finding anything wrong. You are not saying that the entity is doing well. So these are two different statements, and that's why limited assurance is called limited, because there's a negative assurance and there's a less amount of work. You are only doing inquiry or basically ratio analysis of financial statement, basically trying to find the trend. But in case of reasonable assurance, you will be doing the detailed procedures like inspection. You'll be inspecting documents, you'll be confirming to the parties of the amount and balances, you'll be inquiring management and third parties, and you'll be reperforming some tasks to ensure that they are actually being done properly, recalculating the values to ensure that they are actually correct. So these are all audit procedures which we'll learn in later chapters. Okay. So this is basically the idea that reasonable assurance is very detailed. And I hope now we realize that reasonable assurance is basically audit. Audit is also a reasonable assurance, is a type of reasonable assurance. And then I think we went on discussing like why reasonable assurance is not a guarantee, because we cannot, check 100% transition, and we use a technique called sampling. And basically, we will be discussing the audit limitations, audit risk later on. So this was just a brief. I'll try to give you a brief today for that as well. So I hope you guys remember about this discussion about the sampling, that audit is assurance is not never a guarantee. I hope you remember. Okay. This is was for sampling. And even I try to remember what I have written. Reasonable assurance and limited assurance, yeah. And then we touched on separate legal entity. I hope this separate legal entity and limited liability concept was clear, that you cannot sue somebody over their liability. That was the only purpose, and that person cannot be jailed for misdoing of the company unless it's a fraud, unless it's a mis bad practices, unless it's something manipulation of fraud. Until that is the case, most of the time the company's liability would be limited if it's a limited company. Okay, and that basically helps. But because it's a limited company, so we discuss the problem that arises because of the agency issue. Because we were, if you remember, we were discussing about a director basically wrong, not able to correctly incentivized by the shareholder. They try to issue the bonus, they try to give them shares. But if director is only focus is to achieve the target of profit, so they may hamper the long term profitability of the organization. They may try to manipulate the profits. So this this basically, for this very reason, we as a professional practitioners are there to verify that the information that directors are providing are non manipulating. Okay, so I think with this we'll be starting our class. So till now, any doubt? So otherwise I'll start the class. Any doubt, anyone? I hope this was easy though. So even in, see, if you feel shy, so don't worry, you can always contact me on the WhatsApp. So I'm not sure, like any student tried to contact to me yesterday, but I couldn't pick their call. So if you have any query, please try to text me first, and whenever I will have time, I'll try to call you back. Okay. Okay, so let's start. Let's take the pen. And okay, let me just start. So today we'll be starting with the agency and okay. I'll be explaining this case study to you. So okay, please don't start. Please silent my phone. Mhm. Yep. Okay. Sorry, huh? So let's start this. Let me just add pages so that I don't need to do it again and again. New slides. Okay. So do this case study. Though I have explained you the concept, but I'd like to complete this because if it's in your book, so I want to complete it. So please do this case study. Has anyone read it? Anyone read it by themselves? Okay, good, good, good. Okay. So let me explain this. I'll be not pinpointing, like I will not going by single line. I'll be just explaining the entire case to you. So what happens? Let's say there is this person. The person name in the case study is Govan Veera. Okay, if I'm correct. Yeah, Veera. Sorry, it's Veera. So it's Veera. So basically, what Veera does, she is basically in the business of selling flowers. Now, her business is very profitable. Okay, profits are rising. So, and she's selling the business in what particular location. So what happens? She did, because she can see that there is a lot of opportunity. There's a lot of opportunity. People are buying flowers. So she decides to expand her business. And how? She will basically rent a van, basically buy a van or rent a van, and basically hire employees, because she can only be available physically at only one place at a time. Okay, this is human constraint. You cannot be available at multiple places. So she decides to hire employees and buying a van, but she needs funds for that. Okay, so what she does, she actually reaches out to one friend, which is basically what his name, Peter. Okay, so Peter is there. He's rich guy and he has a lot of funds. So she approaches him and asks him to invest in his business. So currently Veera is managing this business, and Peter basically decides to seeing that it is very profitable, so he decides to invest the funds. Now he has given, like, let's say $10 million to Veera. What happens now, because the business is profitable and now it's being operated at two more locations. Okay, it's now operated. So Peter is now considering that business would be more profitable, right? And he would be earning profits. And since Veera is running the business, so he will be paying him salary. So please understand, the money is invested by Peter and Veera is only managing the business because she did not have the fund. So she is not owning the business right now. She is now only drawing the salary. Till now clear? Any doubt? Okay. So what happens? So what happens is that Peter, later on finds out that the business is not, that profitable. Let's say Peter expected business to be profitable like $5 million, but business only generated $1 million money. Like the profit he expected was 5 million and he thought he would be able to recover his money in 2 years, but the business has only recovered 1 million. Like the profit after all expenses is 1 million. And he also noticed that he's paying a salary to the Vera. So Vera is not actually concerned with the underlying results, like what actually comes out of the business. So Vera is not that much concerned by, because Vera is drawing the salary. So she's happy with her salary part and she's not concerned. So, and because this 1 million is basically reported by Vera, Peter is not involved in the business. His involvement is nothing, and he is not the one who's preparing this information. So he needs this information to be verified by a expert. He needs this information to be verified by an expert. Verification is needed, right? So in this case, don't you think that he needs an assurance report here for these financial numbers, right? And this assurance report would be provided by a practitioner, a professional practitioner who is independent. This is what we discussed yesterday. Okay. So this case study basically talks about, and what I want to, why I discuss this case study, because this is something that was pending from the last class, that Vera, sorry, I'm actually mispronouncing the name again and again. Vera actually, has this agent. Vera is acting as an agent because she's running the business on behalf of Peter. Okay, she's running the business on behalf of Peter. Okay, but now because she is not acting with her best capacity, she's only concerned with her salary, and this basically issues, this basically creates this agency issue, which is also called as conflict of interest, because the main person who's interested in this is the shareholder, and his money is at stake. But Vera is only concerned with the salary. So how basically this conflict of interest is met, and this is basically called an agency issue. So this is basically an agency issue where person, basically agent are basically a person who's employed, basically hired, and in this case is a director or management who provide the particular service. In case company, it's running the company, running or managing the company. Okay, and they have second role of trying to maximize their personal wealth in their own right. So their Vera was only concerned with the salary, but whereas shareholder were concerned with the wealth. And tell me one thing, let's say in a P&L, Vera's salary is an expense, right? Which basically brings down the profit. If you pay higher salary to Vera and the business does not, even after that, the business does not do well. So don't you think that the profit level will be down, right? So this is the issue with the agency. This is called agency issue or conflict of interest issue. Now there is a very contradictory concept. This correspondingly a very contradictory concept, and it is called stewardship. Now, can you see Mr. Anderson here? Sorry, Mr. Anderson, Mr. Smith, Agent Smith. Those who don't know, this is a famous Matrix movie. So this is called an agent. They basically work for, the Matrix. So that's why they are called agent. And the irony of this is that they go against the metric ultimately. So that's why I have, the whole purpose of, uh, basically showing you this person is that this person, go contradict to against his principle. So this is why it's called agency show. Now, steward. Can anyone tell me what is steward? Have you heard the term steward? Anyone? In case you don't know, no worries. Uh, okay, no answer. No worries. So basically, stewards are people, uh, not professional. Stewards are basically people who take, basically caretaker. You can, a very simple word for them would be caretaker on behalf of someone. Very good, Aditya. On behalf of someone. So they are caretakers. So their responsibility is taking care of somebody else's assets. Okay, these are assets on someone else's behalf. Like if you can see this person, he is basically ready to serve you. So that's why they are called steward. So their responsibility is taking care of the resources of someone else. And in case of a company, directors are considered steward. And you would find this concept very contradictory to the agency issue, because as per the agency theory, directors are not acting in the best interest of the shareholder, whereas in the case of stewardship, directors are the stewards of the company. They take care of the resources of the company. So these are very contradictory statements, but let me tell you, this is combination of both. It's not like you going to find in a company only a steward or only an agent. You will face that the company, the environment in company operates, it affects completely like what kind of culture, what kind of environment entity has. That actually affects whether entity has more people towards stewardship or more people towards agents. Basically more people who are agents and create agency issues. So great example would be Credit Suisse. Like if you know this example of Credit Suisse, I'm not sure, like this has recently happened in 2021 or 2022, where basically Credit Suisse bank, basically directors were involved in so many frauds and so many mismanagement practices. So they were basically misappropriating the funds of the company. So this was the classical example for agencies who as a Credit Suisse, the latest, one of the latest example. Credit Suisse is actually one of the largest bank in the world, but recently it has collapsed. Okay. And now I hope accountability, I do not need to explain. Accountability is basically holding somebody responsible. And from why we are discussing, why we are learning these concepts, please understand that we need to understand that management or the director are stewards as well as agent of the organization. So we understand that they will be caretaker of the organization resources, but there could be possibility of agency issue. So as an auditor, we have to consider both this possibility when auditing the financial statement of an organization. Everything, everyone clear about this? Right? Clear? Any doubt so far? And you can read this basically that other people also take the benefit of, like creditor or taxation authority, government, basically they take the benefit of the auditor's report. So basically taking care of the stakeholders. Yeah, definitely, Aditya. That is very well put. That directors basically, are supposed to be stewards, but there can be, problems of agency issue. Please don't confuse that directors are not agent. Directors are always agent because principal are the, shareholders. The agency issue arises, that is agency theory. So they are always agent. The only problem is because that they basically, creates an agency issue because they focus on their personal goal, right? So please read this and let me know if there's any concept I need to explain. This is basically stakeholder, which basically owners, customer, government, employee, and these are example like how they read the financial statement and how they get affected. So please let me know if I need to explain. We have already discussed in the last classes. Yes, Mukesh. The actors both are steward as well as agents. basically what my point is, I think students are getting confused here. So let me explain. So directors are agents. Who are agents? Agents are people who takes basically Mhm. who take or provide some services or do some actions on behalf of in principal. Okay. So director are always agent. Whose agent they are? They are agent of shareholders because shareholder is a principal. What I explained you, one thing which is called agency theory. Agency theory, which basically says that there could be a conflict of interest. Okay. This is basically agency theory because this says that director would be interested in managing in basically in prioritizing their own goal in against shareholder goal. Shareholder goal is basically maximization of wealth, right? We all know that, and that could basically lead to basically by how they can maximize their wealth by profit, by long-term projects, right? But what director is only interested in current year profit maintenance, and he do some manipulation. So this is an agency theory. There is another theory which is called stewardship. Stewardship theory says that director will take care. So they are caretaker and they will take care. So this assumes that director are honest. This assumes that director can be, manipulative. So these are two theories. They are contradictory to each other. Director are stewards as well as agents. But the thing is, we have to see which theory prevails to the organization. Okay. Now it's clear. Hopefully now it's clear, right? Okay, any question on this example of stakeholder? I don't want to, waste time on this because I think we have already understood it. So please read and let me know if we can move on or I need to explain anything. I'll be, giving you some crucial concepts today, like framework, materiality. So some of the an objective of auditor, and then we'll be covering the chapter number 2. Any questions till now, or is this clear? Should I move ahead? Is this clear, everyone? Any question, anyone? I hope I don't need to explain this, right? Clear? Okay. Okay. Now, very important. External auditor. This is very important. Let me just, mm, just a second. Keep. Okay. Sorry. So let me just remove these slides and take it here. Yep. This would be better. Now, I hope now we understand what is audit. We are right now discussing external auditor. Okay, please pay attention. This will, make lot of basic concepts. So if you pay attention, there is a word, this external. Why there is this external concept here? This external here. So let's first explain the auditor. So if we take this, so auditor can be of two types. If we go with this word, external auditor, if we are talking about external auditor, so then there must be one internal auditor as well. Okay. And we have seen that audit is basically reasonable assurance. And what that means, that there is an independent reviewer who basically, independent reviewer and who's expert and who provides his opinion. Okay, right? Now, when we talk about financial statement, I hope you remember financial statement are general purpose financial statement. I don't need to explain general purpose financial statement, right, everyone? So what is happening here? Okay, financial statement, which are general purpose financial statement, which basically used by multiple stakeholder, and these are prepared by management or directors. For whom? For shareholders, right? So these are prepared for shareholder. Basically shareholder are principals, and then there is agency issue. We know that there's a separate legal entity. There's a separate legal entity, and there is limited liability. So that makes the owner different from the basically owner and agent different. Owner and manager different. So we need this expert. It's happening again and again. We need this expert who will basically review this financial statement. Who will review this financial statement prepared by the management, right? He will review their work. He will review. So this is a third party. Okay. Now, if you look at this, there's one standard. There's one this standard ISA 200, which basically defines the objective of independent auditor. And I hope now we understand why it says independent auditor, right? Independent because he's a third party. Okay, he does not have any stake and he will review. So what is basically the purpose of the independent auditor is basically enhance the confidence. Enhance the confidence. By how we will enhance the confidence? By verifying. By verifying information, right? So let's look at the definition of audit. So audit basically means financial statement prepared by the management. Please understand, financial statement which are prepared by the management. Audit is basically to enable auditor. Auditor is the third party to express his opinion, basically conclude whether they are accurate or not. That financial statement in all material respect. Okay, I have not explained the materiality till now. In accordance with applicable FRF. Okay, so audit is basically financial statement where auditor would be concluding whether financial statement are prepared in all material respect as per FRF. What does it mean? So audit basically where auditor express opinion about financial statement whether they are in all material respect prepared as per financial reporting framework. Can anyone explain me what is financial reporting framework? Anyone has any idea what is a framework for financial reporting? So I'll be explaining financial material. I'll be explaining financial reporting framework. Anyone knows what is framework? What is financial reporting framework? Very good, Yash. That's very precise. But it's actually based on country to country. I would say it's based on country to country, but yeah, internationally we assume framework to be IFRS and IAS. Those who don't know, I'll be explaining in a moment. Anyone else? Anyone else about the financial reporting framework? Okay, no worries. We are learning. So financial reporting, basically, I would say, you have to prepare financial statements. Financial statement, what is balance sheet, P&L, cash flow statement, SOKI, statement of changes in equity, and notes to accounts, right? These are all financial statements we have understood in the last class. These are considered general purpose financial statement. So if you know, like let me tell you that earlier balance sheet used to be a T shape where assets were reported on the right side and liabilities and capital were reported on the left side. This used to be the format. Okay, old format. Then after the IFRS, now the new format is balance sheet is basically vertical shape. What vertical shape basically means? Yeah, this is vertically. Now it's basically, assets will be reported first here, and then capital and liability would be reported downwards, which would basically match to each other. Okay, if assets are 1000, liability and capital would be 1000. And this is basically new format. So can I say this is a structure, right? And this structure is provided by a standards. And these standards are, provided by regulators. Regulators or lawmakers. Let me just use a different pen. So these provided by regulators or lawmakers. Okay, so basically, can I say they are mandatory requirement that lawmaker, regulator, or government bodies like IFRS is normally issued by IASB, but unless it is adopted by your country, so it is not mandatory. Okay, first of all, understand that. In UK and over 170 countries, many countries have I'm not sure like 170 countries are right number, but many countries have adopted the IFRSs in their respective country. Please understand that. Let me explain. Each country has power of law, like what kind of financial statement they want to prepare. So countries either can prepare their own generally accepted accounting principle. This is called generally accepted accounting principle. I'm just writing in short. I hope you are already aware about it. Generally, which is called GAAP. And each country can prepare its accounting based on its own GAAP, like US GAAP, like India GAAP, Bermuda GAAP. So each country has their own accounting standard, right? And if gaps are rule based, right. So or they can opt to adopt the IFRS. This is optional, based on the country, based on the country's discussion. So internationally, it is always recommended or forced or basically pushed to the countries that they adopt to the IFRS. Okay, I'm not going to explain this in detail, but I hope you understand by this discussion that FRF can be different to different organizations depending upon the jurisdiction and law applicable to them. Is this clear? For a not-profit organization, NPO, balance sheet, and P&L may be different. And for a profitable organization, balance sheet and P&L can be vertically, okay, profit-making organization. And for an NPO, it can be T-shape, depending on the requirement. How basically law enforces the organization. So do you understand that we need to check which FRF is applicable to the entity? Do we understand that? This line about FRF, applicable FRF, that which financial statement is applicable to you, which financial statement entity is supposed to make. Clear everyone? Any doubt about it? Please let me know. Is it clear about the FRF? This is a very important concept. I sometimes get amazed that students are not aware about FRF. They only understand that this is IFRS or accounting standard. No, it can be law, like in case of India and in case of UK, Companies Act. Companies Act tells you basically which kind of accounting practices you would following. Like, let me give you a quick example. I'm not sure like how many of you know the fixed asset schedule. the non-current asset schedule. Are you aware? And it varies country to country depending upon which schedule they are using. Okay, so even law can tell you about like which accounting practices you would be using. Okay, so applicable FRF, everyone clear? Now next point. Okay. Okay, before we move to the materiality, I just want you to read this definition. Please read this. Objective of auditor. We have understood the objective of audit. I'm just, and this definition is, the essence. This is the essence of entire audit. This is the essence. Not assurance, but audit. We have already covered the assurance. We are right now throughout this syllabus. Now we will be covering the audit and the quality management. Okay. So assurance is only this piece here, but now we will be covering throughout this syllabus the audit. Okay. So in audit, this definition is essence because audit is of financial statement, and now we will be focusing entirely on financial statement. So auditor is who's the practitioner, right? So let's say you guys going to be auditors. What Yash says, like companies make different P&L. Okay, you are talking about FRF, right? Yash. Okay. So objective of auditor. Please read this with me. Auditor. Objective of auditor is to obtain reasonable assurance. I hope we understand what reasonable assurance is. I don't need to explain this. I hope this is clear. About whether financial statement. This component is clear. Financial statement. What are financial statements? So auditor objective is to obtain reasonable assurance about financial statement as a whole, free. Okay. Material. Okay. Please, for the time being, ignore this word. For the time being, ignore this word because I'll be covering. So let's read with me. Auditor objective is to obtain reasonable assurance about financial statement that they are free from misstatements. Don't read this material. I will explain the importance of materiality. They are free from misstatement, whether due to fraud or error. So I hope we understand misstatements can be of two types, fraud or error. Basically, let's say I have given you example of, tangible assets. Let's say you can, recalculate the depreciation rate. So either you are doing it intentionally, so that's a fraud, or you are doing it by error. You do not know the concepts of, how to calculate the depreciation. So you did it by error. So this is a mistake. But in any case, the financial statement were wrong, basically misstated, incorrect. Okay. I'll explain the materiality. Okay, so first auditor would be checking whether financial statement are correct or not. Okay, by means whether they are misstated or not. And that will enable them to express an opinion. Very important. I'm not sure whether I would be able to write it here. Opinion, yeah, okay. Modified or unmodified. I should write unmodified or modified. Okay, enable them to express an opinion on financial statement, again materiality, in accordance with applicable FRF. Okay. Yep. So now, in case of non-current assets, what you are saying, Yash? Check with previous financial statement in case of non-current assets. I didn't get your question, Yash. Okay. Now let's understand this entire statement. Okay. First, let's understand materiality. What is materiality? Can anyone explain me? Yes, I did not get your question. Auditor check data with previous year. Yeah, this is audit procedure. This is something which you are referring, that auditor check previous year financial statement. That is something that we will do. Like there will be a couple of stages of the audit. So we'll be checking like at which stage we'll be checking previous year financial statement. I'm not sure like why did you ask this question right now? What was your purpose? So are you basically asking about the applicability, which FRF is applicable? So for that, we would be referring to previous year financial statement. Okay, okay, okay. Yeah, there are many ways. There are many ways to check that. Don't worry. We'll be covering all that. So can anyone explain me what is materiality? Okay, very, that's a, can you tell me what does it mean? Yash Varmani actually given that which affects the decision making. And Aditya has given component that all matter. Okay. Can you define, Aditya, which matters? How do you define what matters? Yash, can you give me an example? Basically, how does it impact the decision making of users? Hmm. Manipulation of accounts. Any misstatement in financial statement can affect the. No, Swayam, this is not correct. When you said any misstatement, nah, this is not correct. I'll explain you in a moment why. This is not a correct statement. When you say any misstatement can affect the decision making of user, I'll explain you that this is not true. And that's why auditor use materiality. Person should before make a matter, a person should making, okay, okay. Impacts the economic decision. Basically, what you are trying, what I'm trying to see is more of a, very practical way of saying it. What you are using is some bookish words, but and that actually conveys the idea, but I'm not sure whether you actually realize what you're saying or not. Okay, when you're saying economic decisions or it affects the decision making, so whether you actually understand this meaning or not. Okay, I get that you are using the bookish words, but I'm not sure whether you actually realize what they mean. Materiality refers to include only important details about a company, for example, huge amounts, bad debts that the company is facing. Very good explanation, Tanvi. Very good explanation. Quality of being relevant. Yeah, hush, close, very close. And Aditya, matter a person should, before making a decision. Okay, so you guys actually have a understanding. Okay, and those who have given the answers about, economic decisions, I'm believing that you understand. In case not, please focus here. Okay, this is important concept because as an auditor, uh, in the last class, we understood that auditor cannot check, 100% transactions. Okay, so let's make one balance sheet. It keeps happening. This is though covered in your chapter 6, but I am discussing it here so that you get a better clarity. I have discussed some concepts which are in your later coming in later chapters, but I wanted to have a foundation. So 100% transition we are not able to check, because if you remember, I given you example of mobile companies or Walmart that you are not able to check even a single day transaction, okay, physically. So what happens, let's prepare one balance sheet. Let's say you are a manufacturing company and uh, okay, you're a manufacturing company. Let's say you have plant and machinery which is of, let's say, 100 million. You have a land and building. Okay, I have written it opposite, so let's make it 100 million. You have inventory because you manufacture, so that would be, right, let's say 50 million. And you have some cash, 50 million. Now why you keep. Hmm, hmm. Okay, so this basically, I hope this basically makes it 1000 million. Okay, now capital reserves, so I'm writing it both together, 300 million. Then there is long-term liability, about 500 million. And then there is short-term liability, about, let's say, 200 million. Okay, let's say when they manufacture, there are approximately 30 lakh transactions. Okay, out of this 800 million, uh, let's say there is one particular land that value approximately, like there are 10 lands right now. There are, let's say, 10 lands, and out of that, one land has a value of, let's say, 650 million, and out of rest 9 land have a value of 150 million. I hope this makes it 180. Oh, 800. So one land has a value of 650 and rest 9 land has 150 million. And this, plant and machinery basically produces approximately 30 lakh transactions. Okay, I should write it here. Now tell me, we have understood that, okay, there are 30 lakh transitions happening in the, in this manufacturing unit, because they are producing a lot of goods and basically selling it. Tell me, when you are verifying this balance sheet, which area you think is most important? Which area you want to focus on? Basically, where should I start? Should I okay, Harsh says capital. We should start with the capital. Who said this? Plant? No, Navi, you have given everything. I'm telling you, tell me the most significant area of this balance sheet. Very good. Yes, Varmani, you have actually pointed out. Can you tell me why? Can you tell me why? Those who are saying, land, can you tell me why? And, they are very specific. Which land? Very good. Everyone, what about rest? Very good. So ideally, in ideal case scenario, though, see, as an auditor, you would be looking at every component. It's not like you are going to leave any component. You are going to look at every component. But right now, if you see, this is a manufacturing company. Okay. And this has a land of 800 million value. Like it has a 100 million assets. And out of those assets, major value is from this land. If you see the major value out of this 100 million assets, if you remove this building, land and building, so it's only 200 million asset balance sheet. So don't you think we should focus on this area? And out of this, there is only one particular land that is basically constituting this entire value, 650 million. These 9 lands, these 9 sites only constitute 150 million. So we should be focusing majorly on this. So because we are not able to, not able to do the 100% checking. We are not able to do the 100% checking. So we should focus on areas. Suspicious? What do you mean, Aditya? Let me clarify the concept first. So you should focus on areas which are most important. And in this case, I can say land of 650 million. Why? Because it's one of the most material, one of the most, utmost important value. Basically, majorly, it drives. Are you getting the idea? That why we should focus on material transition. Okay, let me give you another example. Like this is just struck to me, so this would be a good example for you, and you would be able to relate it. Right now, there are 20 chapters in audit. If I tell you 3 chapters have 45 marks and rest 17 chapters have 55 marks, where would you, put your most focus? Yes, yes, that's a very good way of, Yash has actually, calculated the land as a total value of asset. That is 65%. So that's a very good way. Actually, this is how we, calculate. Like land is, right now 65%, basically 650 million upon my 100 million. So this is actually creating 65%. So that's a very good way of, checking what is the material level. So I was, talking about this. So we have, this in your syllabus, there are 3 chapters that constitute 45 marks, and rest 17 chapters basically, asking you equal effort. only constitute 55 marks. So where would you naturally focus? Why? Tell me why, why? You are answering correctly, but why? Do you get the idea? This is the essence of materiality. Okay? Materiality, everyone clear? That we need to focus on area which drive the most value. If you know, I'm not sure like how many of you know about 80 to 20 rule. Like 20% of your effort does the mostly 80% work, and only 80% effort does the rest 20%. That's 80-20 rule. So this is basically an idea, trying to give you an idea about the materiality. So are we clear about the materiality? Any doubt about materiality? Please let me know. This is a very crucial concept. And this will be covered in, in chapter number 6. But because it is important for me to, make you understand about this definition. Now, please reread this definition. Now, please reread this definition. Okay. Please reread this definition. Oh. Any doubt about it, anyone? Please let me know. This is very important. I don't want anyone to have any confusion because this will impact your exams. Okay. Auditor objective is to obtain reasonable assurance about financial statement, whether they are free from material misstatement. One student said, sir, one student actually said this, and this is an incorrect statement, that let's say this is balance sheet. Oh, okay, let me go back to that balance sheet only. Okay, let's say one student said, sir, if there's a misstatement, then it will affect the user. Right now, your balance sheet is of 1,000 million. Let's say you make a 300K transaction misstatement. 300K means 3,000. Your cash is basically incorrectly stated. Okay, your cash is incorrectly stated with the 3,000 value. Tell me, is it important? I am a shareholder. I have to, go back again. I have to draw more pages. I am a shareholder. I have asked you, you are an ACCA. Okay. I have asked you to review the financial statement. The balance sheet is basically somewhat 1,000 million. And you identified that there is a 3,000 value mistake. And you start telling me, okay, shareholder, please listen, that there's a 3,000 mistake. The financial statements are misstated. Or let's say there's a bank. They are interested whether this 1,000 value is correct or not. You started telling me, okay, this is a 3,000, 300,000 value mistake. Do you think that they would care? Why no? Why no? Those who are answering no. Why no? Why no? Let me tell you. And let's make it practical. Let's make it practical. Walmart. Walmart is a good example. Walmart have $1 billion sale or $1 billion revenue, $1 billion profits. Let's say they had $10 billion profit this year. I'm not sure about the profit level. I have to check the financial statement, but they've let's say they have $10 billion profits. And it was found that somebody has made a fraud, like one employee have stolen their cash of, let's say, 1,000K. Do you think that should, as a banker or as an investor, should we actually bother about such petty things? Very good, Tanvi. That depends on case to case. But right now, the case that I am presenting, do you think that this actually, represents any management? Like, can you question the directors? Oh, director, you are, you have a fraud intention because one employee committed a fraud. And do you think that this is of any significant value? Significant value, right? No, yes, it's a fraud. It's a fraud, but done by an employee, not by director. And in such a large organization, you are trading in multiple countries, multiple locations, so this can happen. There is a possibility of it happening, but you have to see the relevance. you know uh, in case of banks, like let's say Citibank. Citibank, it has operations across the globe. Like it has, how many branches are there? Maybe tens of thousands. Out of tens of thousands, let's say 3 or 4 branches have, fraud or basically misstatement happening. But we have to see how much they, create value, right, for the entire Citibank. Just because 3 to 4 banks, you cannot say that entire bank is misrepresented. So this basically, helps us with the materiality. Now I hope the materiality is clear. Now I hope everyone is understood about the material. So the auditor objective is to obtain reasonable assurance about financial statement, whether they are free from material misstatement. So whether misstatement, yeah, that's the important, like how much apportionment, how much proportion of the total assets, total profits they have, uh, basically, you have to understand, in large organization, not only fraud but error can also happen. Error is a very common thing in large organizations when companies are operating at such big level. So this is very normal thing. So we have to assess whether we can consider that as a material misstatement. Let me give you one very quick example, because I want you to have a very crystal clarity so that you do not get confused. RBS Bank, I'm not sure this was RBS Bank case, or like if I remember correctly, it was RBS Bank case. You know, they have by mistake transferred 3 billion cash, 3 billion cash to a wrong account. This was employee's mistake, but do you see the value? If their total net assets are 20 billion, don't you think that this actually impacts this value? That because of a mistake, you are actually changing the value of the entire organization. So it's a mistake, but it's material. It's a mistake, but it's a material mistake or material misstatement, right? So this is basically materiality does. So as an auditor, you have to obtain a reasonable assurance that financial statement are free from material misstatement, whether fraud or error. And you would be able to express an opinion whether financial statement are prepared with applicable FRF. Now, everyone is clear with this definition, that you need to comply with the FRF that is applicable to you, and you need to check that financial statement are free from material misstatement. And one more thing, just to finish this. When you're complying with FRF, basically accounting standard, can you say that your financial statement are free from misstatements? If you're reporting according to the, what are the financial, when you're preparing financial reporting framework and complying with them, basically IAS, IFRS. So your financial statement are already free from material misstatement. Oh, basically misstatement, not material misstatement. They are free from misstatement. If you, properly do the accounting, so they are already free from misstatement. So your compliance with the FRF basically ensures your, financial statement free from material misstatement. So do you understand the importance of, complying with the FRF, complying with the accounting requirements, right? Everyone? Okay. We'll also see one case when deviating from FRF still comply with, free from material misstatement, still makes you a free from material misstatement, financial statement, free from material misstatement. We'll also see one case. There will be one case where we would deviate from the FRF. We would, not follow the FRF and still comply with the, our financial statement will be free from material misstatement. But we will discuss this case later on. Okay. So I hope now the definition is clear. Any doubt, anyone? Is it clear? This is theory, above part is theory. So I hope you can read it yourself and I don't need to explain that, but let me know in case, you get confused anywhere. So definition is clear about, external auditor. Who is external auditor? What are their responsibility? What are their objective? Clear, everyone? Okay. Okay. So, sorry. Just a moment, huh? Okay. Now, I think this should be easy. So auditor objective is to express an opinion on whether financial statement are given true and fair view. Okay, one thing I have left, true and fair view. I'll be explaining true and fair view in a moment. True and fair view, prepared in all material respect in accordance with applicable FRF. FRF basically vary from country to country. And right now we are assuming that IFRS, International Financial Reporting Standard, is the basis for preparing financial statement right now. For this, syllabus, FRF is basically IFRS. Okay. But it could be basically companies law. It could be basically the accounting practices applicable to you, basically GAAP, generally accounting accepted principle. Okay. Let's discuss the true and fair view. Okay. We all know true. Anyone have any doubt about truth? What is truth? Truth is basically fact. I hope anyone have no misunderstanding about the fact. Like if we talk about water and that is made of, H2O, we know it's a fact. Nobody can dispute that unless you are not in the right sense. So fact is something that has happened and you're reporting it correctly. That is fact. But financial statements are not only expected for basically true, they are also expected to be fair. Can anyone explain me what is fair? What is fair? Why basically financial statement as true and fair? Why not true? If you report everything that is there, so it should be true. Okay, okay. Again, you start using book words. Now it basically, confuses me whether you actually understand it or not. What do you mean by not biased? What do you mean by not biased? Not manipulated or yeah. Okay, but you said it's truth. So how can truth be manipulated? If it's a truth, then how it can be manipulated? You are telling me, right, Aditya, you have given a very accurate answer about not manipulated, not influenced, but you had make us someone's side. Do you see the problem that okay, something is true, then how it can be manipulated? How are you manipulating the truth? Like let me give you two examples, or let's say if one example is enough, then we'll not waste time because we have to complete this chapter also. Just let me quickly add one slide here. I have two examples. I'm just thinking which one to give. But Tanvi, my question is, you are stating truth. So how it's a window dressing? That's my only question. Okay, very good, Swayam. Very good. You have, precisely said what I wanted to hear. But let me explain to everyone now. So Swayam has said that it should be presented in a way that should get the real picture. Now, what's real picture means? Okay, this is a very, very a cheesy type of example. So please accept it because I think this would, clear the picture. I'm not sure like how many of you know Mr. Amitabh Bachchan. He's an actor and one of the famous actor in the India. Okay. In case or in case you do not know him, maybe Tom Cruise or maybe any other famous actor. I'm not sure. Either neither I know him personally, so I am okay. Okay. Whoever whoever you know as your favorite actor, please select them. This is just an example. Okay, great. Okay, okay. Please pay attention here. I give you one opportunity and you start discussing in the chat. Okay. So this is actually a movie scene. This is actually a movie scene. So what has happened that uh yeah. So basically, Mr. Amitabh Bachchan actually goes and confronts a villain. Confronts a villain. Basically, he's there to confront a villain, basically saying that I forgive you, which I don't know why he does that. And later on, he finds out that villain was not there. It's all basically, it was raining heavily and it was night time. So there was no clear visibility. What happened there is that Mr. Amitabh Bachchan found one body instead of the villain. Villain was not there. Actually, there was a dead body and a knife was stabbed to that dead body. Now, Mr. Amitabh Bachchan got so confused. He actually, for what logic, I'm not sure why, he basically pulls out that knife. Now, at that very moment, and this is very interesting, this is basically the typical Indian cinema, that police arrives on that very moment. When you call the police, they don't, usually come on time. But when he pulls out the, knife at that very particular moment, which movie? Forget the movie. Just focus on the concept I'm trying to make. So police arrives and they catch him red-handed. Okay, red-handed means basically you catching someone in the act. So police caught him when he was pulling the knife. So naturally, what somebody would assume that Mr. AB killed him, killed that person. Right? I'm not sure, like, should I use this example in the class, but I think this would, clarify the topic which I'm trying to make. Now, the court session happens and the lawyer asks Mr. AB whether, please look at the question, whether he pulled the knife out of the dead body. Do you see the question? The lawyer asked this question particularly whether he pulled the knife out of the dead body. Mr. AB says yes, because he was telling the truth. But unfortunately, this truth did not, supported his case. So the court decided that he was guilty. Now tell me. I know, but there could be students who have not watched this, because not everyone watches these old movies, right? So I'm trying to create this concept. So tell me, do you think Mr. Amitabh Bachchan should be punished in this case? Though he said the truth was he pulled the knife. But do you think that was fair? Now do you understand the importance of fair? What was fair? Fair was that if the question, let me write it with a different pen. Fair was if whether he killed that person. Answer would be no. So he should not be, held responsible for this. And this is where the manipulation and the real picture comes in. So when Aditya or maybe Tanvi, you actually explained about this. So I was not sure whether you understand what fair means. So fair is basically, let's say director says we have achieved the profit. Okay, if you remember, directors, say that they have achieved 100 crore profit. Okay, they may be telling truth, but are they actually saying that they have preponed or the profit, like deferring payments or basically reducing the depreciation, all that stuff? So you may be saying the truth, but that may not be fair. Basically, the person who's listening getting a different idea. When he's listening, he is not getting the real picture what he intended to do from your information. So that is basically fair means. So everyone clear about this? I hope this example you could uh, uh, tolerate. This is I thought this would be the better example. So do you understand this? Please say yes or no. Everyone. It's Kalia movie. I'm not sure why you want to emphasize so much. Focus on studies, yes. Yeah, this is I thought you many students would recall themselves, but okay. Okay, we served our purpose, we understood about the true and fair. So auditors should give a true and fair view. Okay, on all material respect as per the applicable FRF, and right now we are assuming that FRF is IFRS, and clear, impartial, unbiased information that basically reflects the commercial substance. Do I need to explain commercial substance? Clear, everyone? Now, this is basically telling you that that audit is not an absolute assurance. Is basically this is the limitation of audit, which we have already covered in that last class. Okay. Limitation of audit. Please read it and let me know in case you want to understand anything. We are done with this chapter. Just one thing, I'll be showing you the auditor's report, and we'll be moving to the next chapter. And after the break. And second chapter is very easy. So please read this and let me know if you understand, if you want me to explain any point. Financial statement includes subjective estimates. Yeah. Okay. So subjective estimates, basically management uses their estimates, and provisions, depreciations, these are calculated based on estimates. I hope we understand that depreciation is basically calculated based on the life of the asset, which is estimated by the expert. Okay, so this is a judgment area. Provisions, how much provision is enough? So this is a estimated area. And if you try to challenge these areas, so management can basically have a strong, basically management have a strong basis. They can say they have better knowledge because they day to day deal in business. So we know like how much this asset will be lasting, and how much provision is needed. So these are very estimating area. So this is very hard to challenge to management. So that's why we follow the guidelines. We try to see whether this is me inherent limitation. Yeah, I'm coming. I have not explained the internal control. That's why I was not explaining the inherent limitation. When we say inherent limitation, right now please understand this is characteristics like feature, like something that may happen to fall to a limitation. Let me explain. Sorry. Internal control, basically I have not explained the internal control. Just think that these are systems. These are systems of management, basically that ensure smooth running of business. So let's say one example would be inherent limitation. Let's explain one example of cashier. This is my favorite example. Basically very easy. Let's say you are recording, you are collecting the cash, basically, and you are generating the invoice. Do you think, let's say if an employee of the organization decides that he will be selling the product to the customer but keep the cash in his pocket, and do not record it? Don't you think that if one person has all responsibility and power, do you think that it leads to manipulation easily? There's a chances of manipulation if one person, is recording, is, collecting the cash and is basically generating the invoice. If one person is, responsible for all of that. So there's a more chances of fraud happening. There's a weak systems, right? So this is called inherent. If you, perform a transaction in a way that, inherently, that, by characteristics creates a more risk. Okay, so this is inherent. This is by characteristic, by nature. Okay, so how do we, eliminate this inherent limitation? By, segregate responsibility. That cash collection would be done by a different person, and then basically recording will be done by a different person. So this way we can, reduce this inherent limitation. If you, allow one person to, do all the transaction, then there's a more chance of, inherent limitation. There's a more chance of manipulation, which is basically an inherent limitation. Clear? Clear about this manipulation example of, employee being responsible for everything? So that's why we, have different employees conducting different things. Any doubt, anyone? Okay, representation from management. Basically, this representation is mostly like compliance with laws and regulation. Laws and regulation. You have to, sometimes you cannot check each and every law applicable because there may be 1,000 laws applicable to an organization. So you have to, rely on the organization, or maybe basically estimates like I have already discussed. Or basically, you need to know what has happened in the business that is not in the, financial system. So you have to rely those information based on the management. Evidence is often persuasive, not conclusive. So again, Mr. Amitabh Bachchan example, where knife was a persuasive evidence. The Mr. Amitabh Bachchan had the fingerprint on the knife, so that was a persuasive evidence, but not a conclusive, because it was not able to, conclude whether he killed him, because that was not the real case. So evidences can be persuasive, but they cannot be conclusive. That is one of the, problem with the evidences. Some evidences have a nature that they can only be persuasive but not conclusive. And we do not test all transaction. Test means check. Whenever you see the word test, please understand it means check. Okay, clear everyone? Clear? Any doubt, anyone? We do not check all the transition. Evidences are basically persuasive, like in the case of knife. That's why I've given this example, because it's applicable everywhere. And representation from management, we have to rely on the representation because there's no way to check those representations. So sometimes that is the case that, we have to rely on them. But we will consider one case if the representation is so material, then basically we may not, rely on that. So we'll be discussing that later on. Internal control I have not explained, but right now you can only assume that they are systems that help, management run the business. Okay, clear everyone? Materiality I have already discussed. Please read and let me know. Basically this is your homework. Read and let me know if you, find anything that you want me to discuss. Okay, so basically it affects people's decision. That's the entire idea. Review engagement, again, this is for your homework. This is limited assurance. Review engagement, basically, limited, you are reviewing something, let's say going concern, or, quality management, any aspect. This is basically review engagement. This is part of assurance as a limited assurance. This can be non-financial. Okay. I hope you are comfortable with all this. I hope when I'm giving things as a homework, because I have already explained them. So I hope I do not need to go again, because yesterday we discussed them all in detail. So I hope all is fine, right? Anyone, anybody, any question till now, any topic they want to discuss? Clear? I hope my speed is okay. Please let me know. If you don't let me know, then I wouldn't be knowing this. Okay. Now, finally, the report. So I'm not sure, should I start explaining the audit process right now? Okay, let's discuss the audit process, because only then you would be knowing this audit report, the significance of this audit report. This is an audit report. This is, one of the last steps. One of the last steps, not the last step, one of the last steps for audit. So let's me explain you the process. Okay. And then we'll start the new chapter. Okay. So, mm, audit has three main steps, three main stages mainly. Preparation for audit, performance of audit, and finally, the conclusion of audit. Okay. In preparation, we check whether we would be, accepting the client. So why will be, okay, I'm not, did I discuss the audit risk? Did I discuss the audit risk? I've not forgotten. Yeah, just 10 minutes. Did I discuss the audit risk? No? Okay. Audit risk. Okay. Just one thing. Actually, I just remember I cannot discuss this without audit risk. Audit risk. It's a very, very important. Mostly examined. Basically, it's chapter number six, but I'm just giving you a preview, like how will be. And then when we'll be discussing chapter number six, so you already have the idea about the audit risk. Okay. So audit risk is, auditors is responsible to express opinion on financial statement about their accuracy. Can I say that? And when I mean is that they are applicable, they are basically compliant with applicable FRF. I should not say compliant, I should say true and fair, because compliant have a different meaning. They are true and fair with the applicable FRF, right? I hope you understand. There is no misstatement. They are basically prepared as per the applicable FRF. So auditor will express their opinion on that. That basically this is prepared by the management. Prepared by the management. It is their responsibility. So auditor checks whether management has met their responsibility. So whether the financial statement are actually prepared accordance with the applicable FRF. So auditor will check that. So this is his responsibility. But we have learned that auditor does not check 100% transaction. He only checks material transactions. I should use blue pen for this. Auditor only check material transactions. What if non-material transactions, what if non-material transaction actually has some materiality, but auditor did not check? Or let's say he checked one material transaction, but because of the limitation, because of the 100% checking limitation, he could not check completely, because even material transaction can be, large number of transactions. There can be large number of transactions even in material transactions. So even there you have to do some sampling, some limited checking. Sampling means limited checking. So don't you think there is a risk, there is a risk that auditor may not give correct opinion? What it means, that financial statements are materially misstated, but auditor says they are correct, or basically auditor issues an unmodified opinion. Unmodified opinion means auditor says everything is correct, or unqualified opinion. It's called a true and fair view. Auditor says that in the financial statement everything is true and fair. He issues an unmodified opinion, but actually that is not the case. Auditor, by because of the sampling risk, or because of the he could not find the right account, he could not check the right component of the financial statement, because of the sorry, for the poor planning, he could not check the financial statement correctly, so he issued a incorrect opinion. So is it not the risk of audit? Auditor responsibility is to express opinion on financial statement, but if he issues an incorrect opinion, is it not basically make it an audit risk? Does it not make it an audit risk? We'll be discussing audit risk in very detail, about the inherent risk, about the internal control, about the control risk, and then detection risk. So there are three components, but that is something that we'll be discussing in chapter number 6. So audit risk is something that auditor failed to express correct opinion. Is it understandable? Right? And this is something that we will be covering throughout this syllabus, that how auditor ensures that he does not, basically his audit risk is low. Please understand, audit risk cannot be eliminated. There is always going to be a risk. You are checking somebody's work, and there is always a possibility that you may not check it correctly. Why? Because of 100% transaction testing, you do not test or check 100% transaction, and there could be non-sampling risk. Non-sampling risk basically related to that uh, let's say you do wrong judgment about materiality, about material items. There are many components in a balance sheet. Can be fixed, non-current assets, like in non-current assets have many components, current assets have many components, liability have many components. So you basically missed to check some transitions where you should have checked. Okay, you made poor judgments. You were not, you did not were clear with your concepts. This could also be the case. So this could basically lead to audit risk, that you give incorrect opinion. And that's why it always said that you can never eliminate. Let's say you take the very experienced people, you take more experienced team with you, highly qualified people, still there are chances that you may not give 100% opinion. First reason is 100% testing, and second reason is that there could be other matters that were beyond your control. So audit risk can never be eliminated, and audit risk is something that auditor is always afraid. And that's why we will learn that what is the importance of evidences and documentation. Because if you issue an incorrect opinion, shareholders or stakeholders may sue a case, may sue you. They may file a case against you in the court. So you can be at risk. And audit is highly regulated, so there can be some punishment as well. Lawmakers, regulators can come, and we'll discuss this in a moment, like in the chapter number 2 we'll discuss this, that what is the relevance of audit risk, and why this is regulated. If you remember, in the last class we discussed about the impact of financial statement on economy. If you remember, right? I hope we remember about the economic impact of the financial statement, right? And think about it, that regulators are concerned with everyone who's involved with the financial statement, those who are preparing it, those who are reviewing it. So if you make any mistake, so you will be punished for that. You are a professional, so either intentional mistakes or error mistakes, both are not allowed. You are a professional, This is a professional course. So you are expected to have some standard practices. So if you made those standard practices and then there is a case that happens, then you can basically showcase that this was beyond my control. But if you become irresponsible, or any area where you're supposed to be checking things but you did not, so that basically makes you accountable. If you remember, we just learned about accountability, agency stewardship. So not only board of director, we are also accountable. Okay, everyone clear till now? Audit risk clear, that there would be an audit risk? Any doubt? Only few students are answering. That's why I feel like I don't want students to have this doubt, because these are fundamental concepts. Okay. Okay, now students start pouring. Unless I tell students, they don't start pouring the answers. How's the Josh? Okay. Yeah, we are at finish line almost. Okay. So what I was telling, that audit is of majorly three stages. First is preparation, second is performance of audit, and third is conclusion. And in conclusion stage, you basically issue an audit report. And that's what we are right now looking. And in preparation stage, you basically start evaluating. I'm just giving a quick brief. Like you would be whether you would be accepting a client, because there can be an audit risk that you may not detect the misstatements in the financial statement. Okay, there may be risk. So you would not accept every client. You would only accept those clients where you are confident that you would be able to detect any misstatement. If you are not confident that you would not be able to detect the misstatement, you would not accept those clients. So they would be we will be learning about the preconditions of an acceptance of an audit. It's not like you are going to accept every audit. Okay, there are preconditions. And then basically in the ISA 200, we just learned today that there is objective of auditor. The responsibility of auditor is to express opinion on financial statement, whether they are free from material misstatement. Okay, so all these things will be basically obtaining an understanding and of an entity, will be obtaining, because we have to see the audit risk, like how much of the possibility of audit risk. So we have to obtain an understanding, like which sector they do the operations, hotel sector, or basically IT sector, or maybe aviations, and whether we are familiar with that sector. Okay, do we know about the accounting policy of that sector? Okay, do we have expertise in that sector? Can we actually understand the business? Because of the IT involved right now, there's a big data technology, emerging technologies like like machine learning. Okay, and then there is artificial intelligence. All this stuff is there. So are you able to grasp all this? Are you able to understand the environment of an entity? And then basically you can check. See, the fundamental of an audit is that you can only check if you know what is right. So do you know what is right? Do you understand the right here? Do you understand the entity? Do you understand the systems? If you are working in a large organization, there is no such thing as debit credit. The systems that I'm not sure like how many of you work on tele, but if you work in a large organization, this is not a they do not use software like tele where you would be swinging accounts debit and credit. No. Yeah, SAP. That's very well pointed, Yash. In this, you'd be seeing positive amounts, negative amounts. You'd be seeing, summary of data, and you need to know how to learn those data, how to read these data. Okay, if you're not expert in that, then you would not be able to check things, because you would say, okay, give me balance sheet and PNL, and they would be giving you bench of Excels. How would you check that? Okay, do you understand the importance of understanding the entity? Because if you do not understand the entity, then there would be risk of audit. Then there would be performance. So during the performance, we would be doing our testings. Testing means checking. Okay, I hope I do not need to explain again testing. So testing means checking, and there would be two type of testing. Testing of entity system, how accurate their systems are, and testing documents, basically it would be called substantive testing. I know this could be overwhelming of information, but just an overview. Just try to absorb as much as you can. If you're not able to absorb, no worries. We'll be covering them in detail later on. But I just want to give you an overview. Like we'll be performing. That's why I'm constantly asking Yash in case anyone is feeling any doubt, right? So that's why I'm constantly asking. See, if you do not understand anything, please let me know. I wouldn't otherwise know where I need to, focus. I would be going with my rhythm. I hope everything is fine till now. So in the performance stage, you would be basically, do the testing of the information. You would be basically try and understand this is a verifying stage. You are verifying information right now in this stage. We'll be covering this in very detail. Like this is the only like testing performance evaluation is the only area in the audit. You would be checking a lot of things in this here. Okay, 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 okay. And finally, conclusion. So you basically planned your audit here, you verified the information here, and based on that, you conclude, you draw conclusion, you draw conclusion. So you would be issuing a report. Okay, you would be issuing a report. So based on the verification of evidences, based on your planning, your understanding, you basically obtain an understanding of the entity. Based on that, you check significant components which you find basically were relevant or material, and then you basically concluded your you draw some conclusions. You drive, okay, I can say that entity is actually reporting its financial statement correctly or accurately. Okay, after verifying things. Once you have verified, then you are in a better position to say whether everything is correct or not, and then you basically issue audit report. This. So this series basically this will be basically auditor report would be something where you would be expressing your opinion. Okay, you would be expressing your opinion. Yes, and where the financial statement have been prepared in all materials spec and FRF. So let's see one audit report, and then we are taking on break. Okay, just one audit report, and this is actually given in your book. So I'm actually showing you the book. And after that, we have a 10 minutes break. After that, just let me show you the audit report, please. Just 5 minutes more. Okay. So I'm just stopping my screen because I have to open the internet. And let me know if my screen is visible now. I am basically on the Internet Explorer. Okay, so let me know if you can see this. Okay, not the PPT. I'm not on the PPT right now. Visible, everyone? Yes. So this is your, in case you have the BPP book, so you would be getting a code and you would be able to log in through the online portal. Okay. So yeah, ebook. This is a ebook. Okay. So in case you have the BPP book, you would be setting up your password like any login password. Uh, now I think that you guys are too familiar with this. Okay. Okay. And then like you would be getting a couple of books. Whichever book you buy basically will be available. Like this, these are all my books which I bought and logged in, and this is currently your audit and assurance. So PPP book currently looks like this. Okay, this is a red book, and this is a workbook. Okay, we are not opening practice kit. Practice kit has questions. This is a workbook. Okay, let's open this. Okay, so this is the chapter. I actually, as I told you, these are the chapters. I hope whichever book you are using, you have books with you. Okay, like is there any student in the class who does not have any book like Kaplan or BPP any? Because I expect you to have at least a practice kit so you can start practicing questions. I'll be giving you homework today. Okay, so let's jump to the chapter number 1. Okay, please arrange the book, Mukesh, as early as you can, or you can basically, use this ACCA study hub. Please use this. My notes are sufficient for concepts, but you need something to practice on. Okay, whatever I'm teaching you, you need something to practice on. And everyone, this is something that we have already, covered throughout the class. Okay. So you do not need to worry that we have left any concept. Even if you want to check, so that's fine with me, but most of the concepts are already covered in the notes. Okay, okay. Okay, no worries. Yeah, this is the same approach I use, Yash. Otherwise, I do not have any option. I basically share the questions, and anyone whoever has the book basically takes the photos and shares in the group. So any student who have the book can share the questions in the group. Okay, so I want you to practice the questions. Okay, so please understand, when we talk about auditor report will always be indicating an independent audit report. Okay, whenever we are talking about external auditor report, okay, external that means there is also an internal auditor report, but external auditor report, which is basically a reasonable assurance, will always indicate to the independent auditor. So this is the heading. Okay, an unmodified opinion is basically auditor is saying everything is correct. Everyone, do I have your attention here? You can see the screen now. Okay, so this is an independent auditor report. I hope we understand what is an independent auditor report now means, and it will always be addressed to the shareholders. Like in case of a company, it would be addressed to a shareholder. In case of an NPO, it would be addressed to the trustees, or basically whoever runs. Or in case of government organization, it may be addressed to the government. Clear? So it will be addressed to the shareholder, and the first thing that you would basically start your report with your opinion. So the way, basically this has been revised like a couple of times. So earlier this report was not like this. Earlier there used to be a description about auditors board, what auditors board is all about, but later on it was revised, and basically it was considered the best practice to start the report with your opinion. So here you would be basically expressing your opinion, what you understand, so that the users of the financial statement actually focus on the area that they need to focus. So because there is a lot of information in the audit report, so we'll be first starting with our opinions. So this is basically the opinion. Opinion is, we have audited the financial statement of ABC company. So this is the company, and we are saying we have audited its financial statement, which comprises the financial position. I hope we understand financial position is balance sheet. I hope we understand that financial position is balance sheet. Statement of comprehensive income statement, which is basically P&L, and statement of changes in equity, which is called SOKI, statement of cash flow, and notes to accounts. This is basically notes in the financial statement, and significant accounting policies. So what we start with that we have audited the financial statement, and we explain what are financial statements. So financial statement as per applicable FRF. Okay. In our opinion, financial statement present fairly in all material aspect. Basically, you have basically two ways of saying. You can say present fairly, or you can say it gives a true and fair view. So in a very starting line, we say that whether financial statement present fairly or not, whether they are true and fair view, whether they represent true and fair view. Okay. And then basically we will be saying that they have been prepared as per the applicable FRF, and here FRF is IFRS. Okay. And then we will be giving our basis of opinion, like what our basis, and we'll be telling them like we have audited as per the international accounting standard. Like if you remember, in the assurance engagement there was one criteria. So I told you the criteria is best practices in case of building construction. Here the best practices would be international accounting standard when we are auditing the general purpose financial statement. Okay. We have audited in accordance with the International Ethical Standard Board of Accounts. So basically, what this line is saying, there is a ethics. You guys all are ACCA. So, you all guys all are professionals. This is something which is about to come. You guys are ACCAs. Okay. You are professionals. And there is a professional body. Can you tell me what is the professional body in our case? Who's the professional body in our case? Everyone quick. Which is our professional body? The question is, we are ACCA professionals. We are studying for ACCA professionals, so we become ACCA professionals. So who is our professional body? Who regulate us? If you do not understood the question. No, Tanvi. ISB Yeah, Harsh, right. Sakshi, right. It's ACCA Global. ACCA. ACCA is our professional body. We are ACCAs. We represent the ACCA. Okay, clear? So ACCA ensures that we do not misbehave, and by misbehaving, any unprofessional behavior. And by that I mean any irresponsible act. So we have to comply with certain ethics, and ethics include, bribery type of thing. Like we do not accept any bribery. We do not, act in, no, we act in best fiduciary manner, basically in the best interest of the stakeholders. Okay, we do not, advocate the client. Okay, we do not advocate the client. We act in the best interest of stakeholder. We do not accept any bribery. So we are supposed to comply with certain ethics. Okay, so this is something that is applicable to you, and this is what this report is saying. Is is this PPT visible? Is this PPT visible? I was actually writing right now. I'm not sure like how many of you know I'm writing. No, no. Okay, 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 okay. Yeah, actually, this is problem. I'm not able to multiple share at time. Oh, sure. Okay. So I basically, when I was explaining, I actually was drawing all this. Like I was actually explaining the ACCA is a professional body and that we should not misbehave. And misbehave basically means irresponsible act or unprofessional act. And we need to do we are not supposed to do the bribery. We are acting in the fiduciary interest, basically stakeholder interest, and we do not advocate the client. So these are some ethical compliances. And I have to do this screen sharing a lot of time then. So this is basically the statement is saying that we are acting in the best interest of the client. Basically, we are complying with the ethics. And then there is a key audit matter. That something that I think we should cover later on because that will be a very detailed discussion. And please understand this term. Those charged with governance. Those charged with governance means management. Whenever you heard this term TCWG or those charged with governance, this is basically management. We'll consider what is auditor's responsibility, what is management responsibility. Management means those charged with governance, and auditor's responsibility, and then we'll basically conclude our report and sign it off. Okay, so this was the auditor's report. Please read once. Please read this once. I have skipped a lot of stuffs here because there is a lot of stuff that would be coming later on. So I just wanted to introduce you to the auditor's report and this term, this unmodified opinion. So we'll be discussing it later on in detail. So for this, we have completed our chapter number 1, and I hope you have understood the concepts about the audit and assurance engagement, and now we'll be exploring them in later chapters. So with this, we have a 10 minutes short break. Like we'll be meeting at 8:10. So let me know in case of any question or any doubt till the time, till the time we are in break. Okay. Okay. Yes. I have to ask, like, am I audible? Yep. Okay. Let's be on break. Everyone, are we back? Yep, 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 yep. Okay. So let's start our second chapter. And for just a moment, huh? For chapter number 1, if I remember correctly, just let me quickly check. Question number 1 to 1, 3, 4, 3 31, 32, 33, 35. Okay, I think this is already given in the series. So let me check 213. Can you do 213 question? Okay, 213A. You would be able to try to see whether you can do 213A. It's a case study based. And 215 and 216. Yep. Do these questions as a homework for chapter number 1. Okay. And if you want, in your BPP practice kit, sorry, in your BPP workbook, if you log into your ebook, so there are further questions available. So please do those questions as well. Whenever you complete a chapter in your BPP, so there will be some questions practice given for you, further question practice that is available in your ebook. So please do those as well. Okay, everyone clear about the questions? We'll are starting with the chapter number 2, and this is a very easy chapter. Basically, giving you the idea about like what is like the applicability, the enforceability of audit, right? So as the name suggests, it's rules and regulations, basically laws applicable. If you remember, we discussed an example of audit, statutory audit now. So this is where we will be covering this. And from now onwards, please understand, majorly we are covering audit of financial statement for a company. Basically, there are other organization like non-profit organization, government organization, but majorly it's company. Throughout the syllabus, we'll be covering the company. Okay. But if the exam question comes for a not-profit organization, please accordingly change your answers. Okay. And we have a separate chapter for not-for-profit organizations. Okay, let's start. Everyone back now? Okay. I hope my screen for PPT is visible. You can see this. Let me just quickly do some arrangement for multiple part. Control. Yep. Now I hope. Yep. So let's start. Very easy chapter. Chapter 2 about regulations. So this basically is about laws enforceable. Laws enforced. So which are applicable. Why I write this? Next. So what we'll be covering here? We'll be covering regulatory environment, like an environment in which entity operates. So it has several laws. Let's say IT company would have more IT laws. In case of a manufacturing entity, so it would have to comply with laws related to manufacturing. So the environment basically where the environment that is applicable to the entity and where the external auditor take place. Okay. So reasons for these regulation of auditor. So this we have already covered. I'll be just touching upon it. Statutory regulation governing the appointment. Basically, how do we appoint the auditor? What are the rights of the auditor? Who basically can remove the auditor? Whether auditor can resign. So this is something related to auditor, and this is very easy to understand. So we'll be just touching upon them. Rights and duties of auditor. So this is okay. 2 times this has been written. Development instead of international standards. So here we'll be discussing about IFAC body, IAASB, the ethics boards, ESB. I think I'm not very good at remembering the names. So international ethical standard board as well, the role of ACCA, and who is qualified to be auditor. So just a quick answer, like a qualified auditor would be an ACCA who has membership. Right now I'm an affiliate. I'm not a member. I have not applied for the membership right now, so I'm not eligible for practicing the audit. Okay, only members of the ACCA can act as an qualified auditor. Some personal reasons. don't worry, membership is a good thing. I have not applied for my own personal reasons. And if you want, we can discuss it separately, whether you should be, applying for membership or not. But that is a separate discussion that will happen once you clear ACCA. Okay. Or if you want clarity, we'll discuss, but separately, not here. Okay. Relationship between international standard auditing and national standards. Okay, so basically they are international standards and then national standards. So how do they basically relate? And basically who has higher authority? Let's say there is a clash between the two standards. So who would basically prevail? So this is what we are going to discuss in this chapter about the auditor's rights, auditors, obligations, basically responsibilities, who can appoint the auditor, whether auditor can resign, what would be the circumstances, what are the laws applicable, and basically the boards applicable. Okay, I hope the idea is clear. So I hope when we say framework, now you understand that it's a structure we are right now referring. So regulatory framework within which external auditor operates, on how auditing professional is regulated. So it is regulated right now by IAASB. Okay, rights and duty of the auditor and specific processes for auditor appointment removal. Okay, this is basically telling you about IASB, International Auditing and Assurance Board, IASB. Okay, need for the regulation. So simply, if you remember the benefits of the audit, so tell me, why do we need the regulations? Just tell me, why do you think regulations on audit are required? Without reading this, okay. So that audit can be done in proper manner. Okay, enhance the credibility, trustful information. Yep. So if you remember our discussion about the economic impact, like uh, the economic impact of financial statement, right? What financial statement has impact on economic and users, several stakeholders, right? So that's why it is very important that everyone involved in the financial statement preparation and review are basically use the best practices. Also that they do not manipulate results. Auditor do not favor the management. They do not manipulate the results. Manipulation does not happen, right? So, and if somebody tries to do that, so we punish them. And that is the need for the regulations. So regulation basically enforces people to behave professionally. So that's why we have companies, this is something that you can build, that basically trust in audit profession. But the entire idea is that right now in UK there is a Companies Act. Okay, this will basically enforces the companies. So any company, any organization that is registered as a company, any organization just that is registered as a company in UK is required to have audit. Okay, in India, same case. In UK, this is Companies Act 2006. In India, we have Companies Act 2013 in India. Okay, and basically, if you go to the US, so you will see the Companies Act there and their basically applicability. And this is something which is called Sarbanes-Oxley Act, and this is also known for Enron, famous Enron case. And if you remember, I have told you about Big Four. There was earlier used to be Big Five. And this is only because of the Enron case that now there's only Big Five. So this is a chapter number 3, corporate governance. Enron case is actually discussed there in detail, but if I feel like, I would be discussing it here. Okay, so we'll be skipping that there. Yeah, in UK, it's basically Companies Act. Right now, the applicable Companies Act is in 2006. In India, we had Companies Act 1956, which was replaced later on in 2013. Similarly, in UK, there was a previous Companies Act, which later basically updated with this Companies Act 2006. Okay, so it depends on country to country. That's why it's called national law. Okay, so first of all, the audit would be, would be regulated with the national law, the country that you're living in, basically enforcing some laws on you. Okay, the auditing standards. So that depends on the national law, whether they allow you for the international standard or they allow you for the local standard. So in India, we have SAs, standards on auditing. Right now, we are studying international standards on auditing. And you would see that these standards are very similar. Like, just changes are based on local requirements. Otherwise, most of the standards are matching with each other. Okay. And let me just quickly add one more thing. I actually forgot to add in the basics fundamental. So this is for standards. This is for understanding of standards. So you call it ISA, which is basically international standard. International standards on auditing. Then there is standards on auditing. Like, this is an example of India. This is an example of India that we have standards on auditing, which is basically normal national standards. Basically, when you are auditing any company of India, so you have to comply with the standard requirement of the India standard. When you are auditing any company of UK, so you have to see whether there is any national standard for the UK. So right now we can see that this is ISA. So if there's any national standard, so we'll comply that. So please understand, ISA and SA. So SA would always prevail over ISA. Why? Because SA is national requirement. So SA would always prevail over the ISA, first thing. Second thing, which I forgot to include in the last class, sorry, in the previous chapter, is that series of ISA. So, standards are issued in a series way. Like, there would be a 200 series, there would be a 300 series, there would be a 400 series, also 400 also, 400, 500, 600, and 700. And each series represents its own purpose. Like in this series, you would see objective, uh, precondition, like there is ISA 200, there's ISA 200. You don't need to remember this. This is just for FII. You are not supposed to, remembering or memorizing this. In case you can recall, that's good thing. You can mention in exam, that's better thing. But it's not that you will be given marks solely based on your memory. Okay, you need to get marks based on your application of knowledge. Okay, 300 basically, 300 series basically starts with 300 about planning, then 315, 330, 330, very important. This is basically, telling you about audit, risk, and responses. This is very important assess. And then there's 320 for, materiality. Even for sampling, I think if I remember, 330 sampling. 400 series, if I remember correctly, there's 402 for, service organization. If I remember correctly, I'm not sure like this is correct for 402 or 499 basically for joint auditor. This is 500 series. It's a very crucial series. In this, you would be seeing evidence for 500. 501 for inventory evidence. Inventory has separate, it is the only component of financial statement that has a separate standard, inventory, 501. There is 510 initial audit. Let's say you're doing audit of an entity for the first time. So it's called 510. You don't need to remember, I'm just telling you. 520 is analytical procedure. Basically calculating ratios. How would you, when you would be doing analytical procedure at the beginning of the audit or at the end of the audit. So all that stuff. Right? And 530, I think this is 530. 530 is for sampling. 330 is not there. 330 is already covered here. Yeah. And 550, 540, 560. Basically, this is for estimate. 600 series is for auditors. Basically, expert. We'd be dealing with the expert, and 700 is for reporting. Let's not go into detail like which standard is there. Whenever any standard would come, I would basically explain it to you. I just wanted to give you that there are series like 200 series and 300 series and 4 5 6 like this. So these are for ISS. And similarly, if you remember in the last class, we also see one, assurance engagement standards, ISAE 3000. So I forgot to, explain to you in the last class. So just I recalled, so I thought I would be explaining to you. Okay. So, need for regulation. I hope we are clear that we need to regulate the profession so that it enhances credibility. It, regulates the profession, that there is a less chances of manipulation. It punishes the defaulters. In case of Enron, in Enron case, what has happened, that the company actually, went into bad, fraud practices. It actually reported revenue which was not actually existing. Okay. And their auditor, who had the responsibility to check and tell to the world that it is actually, reporting an incorrect statement, they actually, got involved with the management. They bribed the auditors, and the auditor did not say anything where they were supposed to say that. And when it was found that Enron has actually made, billion-dollar is on billion-dollar losses, and have fake assets and fake revenue, so the Enron directors went into the jail. And the auditors that were, doing the audit, it was basically Arthur and Anderson. So it was called, AA, the big five. And basically, it was fined and banned, and the auditor who did that basically went into jail. So this is basically, the impact. And that's why we need to do the regulations. That's why we regulate the profession. And there's national law, there's accounting, auditing standards. I have just explained that there's an international standard, there would be local standard. So you have to, follow the national standard first. In case your regulatory body, your national body allows you, so you should follow the international standard. Okay. And then there's codes of ethics. This is basically enforced on you by ACCA. So ACCA wants you to behave professionally. ACCA wants you to be updated. Let's say, think about a professional accountant who has done ACCA 10 years ago, and then he did not, updated himself. There has been so many changes in the accounting environment. Don't think that accounting and finance profession does not have any update. Just like technology, we have so many changes over period. Like now you can see artificial intelligence. So see the rise of fintech companies. You can see the rise of, complex accounting. See, so this is a constant changing environment. So that's why, ACCA, as part of the codes of ethics, ask you to continuously professionally develop yourself. So there is a CPD requirement. Okay. So this is something that basically, ways that they regulate you: national laws, ISAs, and codes of ethics. Clear, everyone? Any doubt? The need for regulation. This is something basically you can read as a theory, but this is something that I wanted to tell you for your information. Okay, legal requirement. In this section, basically UK, we are basically in the chapter, we are referring the UK and companies at 2006. So this is basically legal requirement from the point of view of UK. And as they have said, that different country apply different requirements. Okay, there is no uniformity as such, so we have to see the national law. So which, and basically, like in India, any company that is registered, any registered company has to do their audit. It is compulsory. There is no exception. If you are a company, even small, even big, you will have to, you are required to have yourself audited. But this is not applicable in each country. Like in case of UK, there are, small companies or owner. They basically say, let's, exempt these small businesses from audit. However, if they are from a particular sector, let's say they are financial sector, they are listed, but I don't know, I find this statement very contradictory. I find this statement very contradictory. Why? Because first you are saying that you should basically, get yourself, if you are a small business or you are a single owner managed company, then you should not get them audited. But then it's saying that if it's listed on stock exchange, you cannot get yourself stock listed on stock exchange if you are a small company or a single owner managed company. That is not possible. Not sure why it was written. Okay, anyways, so what I'm going to discuss is why small companies is basically exempted. Maybe they can ask you basically question about like small companies, basically they can give you case study and basically ask you like why small companies are exempted. Okay, and that's actually, tells you something about audit as well. Like audit is not something that, everybody celebrate. Audit is not very celebrated thing. You know, when a financial statement gets audited, so we understand assets and liability component will be audited by a auditor. Okay. And financial statement are prepared for a period, let's say Jan to December. So there would be accountants, management, finance professional, directors involved in preparation of financial statement. Now, when these statements are getting prepared, you also have to get them audited. You would not believe that auditing is such a tremendous exercise for an organization. It's a very heavy exercise. Okay, people don't like welcoming auditor. It's just that they have to because law requires them. You have, because now you are checking somebody's books of accounts. You are checking somebody's books of accounts, and this is not prepared by you, so you need lot of explanation, a very detailed explanation. So don't you think that would involve cost and time, right? It would involve a lot of cost and a lot of time, lot of manpower would be required. In an organization, in large organization, the people who do the accounting and financing jobs, they have to separately allocate their time for the audit purpose, and they are never happy about it because they are already pressured with the workforce, they are already pressured with the work requirement, and now they also have to deal with the auditors. And this it basically disrupts businesses, because now a significant portion of your manpower is dedicated for the auditing. Now, one more thing, auditing is for, if we understand correctly, auditing is for the purpose of, I don't like it. Auditing is for the purpose of, shareholders, stakeholders, right? The major concern is that they are not involved in the business directly. They are not involved in the business directly. So it's better that a third party reviews the work for them, right? This is the main purpose now. This is the main purpose now. Yeah, I know, Yash. I know. If you have worked in the audit, so you have faced this practical issue. Like if you are working as a, if you are working in the accounting department, or you're working as a, from the company side, so you would not welcome the auditor. If you are the auditor yourself, so you have to work, a lot of hours. You have to spend a lot of hours just checking informations. This, requires a lot of time and effort of each and every individual. Okay, so let's come back to this. So shareholder and basically stakeholder require the auditing because they don't know what's going on in business. But what if I say I'm a small business owner? I run my company myself. Now, do you need any third party opinion here? What is the relevance of getting your financial statement audited here? You are the director of your company. You manage your company yourself. You have invested your money. So do you think that actually it creates any benefit? Actually, it does. Actually, it does. It does. I will tell you what it does, but still, I would actually compare. I would tell you why it's still not relevant. As a owner, it does not help me. Why should I get my financial statement audited? I'm doing my business, so I know, and it's my money. So whatever happens is basically I'm responsible for it. and it is my stake, right? So for as a owner, for not. But let's say if you're a bank and you want to give, and basically this small owner has come to you for loan and is preparing his financial statement. So do you think bank would benefit if the financial statement are audited? And for small businesses, it is mandatory requirement. It is mandatory requirement to have their financial statement audited. Because how would bank know that you are reporting correctly? Tanvi, why no? Why no? Bank would definitely get benefit if a financial statement is audited. Bank would always like a verified statement, right? Right? So that's why bank would benefit in this case. So that means some stakeholder like creditor or bank would benefit from the audit, but the owner would not get benefit from this. Okay, okay. They can be biasness. Yeah, definitely. So I mean, if the so they can be definitely biasness. Yeah, yeah. Bank, because bank don't trust the numbers unless it is verified by a third party. But let's say as a small business, the cost of auditing, because auditing requires a lot of manpower, a lot of time. So it would cost, like let's say business earns, let's say 100K, and auditor fees is like let's say 30K. If a business earns 100K and auditing fees is like 30K, do you think a small businessman would like to get them himself audited? Think about the cost. So you have to see whether the benefit you are trying to yield, benefit you're trying to yield from the audit, is it worth the cost? Please shut up. Is it worth the cost? So that we have to see, and that's why small businesses have been considered. See that it depends completely on the nation, like how nation treats its businesses. If it says no, it wants to be strict, so it would not give any exemption to small businesses. But let's say if nation wants to encourage its businesses, and it does not want it to get business owners into this compliance cost issue. Because if you are discouraged in the first place with the things like you have to do a lot of filing, do a lot of paperwork, and incur cost for those paperworks, so you would not be encouraged to do the business. So this basically is only for encouraging the business. you know the reason for exemption is for encouraging the business, reducing the compliance cost. And since if the benefit is there for the banks and for the government organization, it does not yield that much benefit. What if the businessman does not do the business? It's more hampering than getting these numbers not audited, right? I did not get it. Yash, why did you say this is applied to ACCA like in the case of CA? What do you mean by that, man? Like, did I miss something here? No, no, that is yes. Performance of audit of performance of audit of relatives. That is something else. That is something we will be doing. Like who can do the audit? That is something a different case. Uh, when you are doing your own audit or your relative doing your own audit is a different thing. I am right now talking about small businesses getting exemptions. So are we clear about why small businesses get the exemptions? Okay. Are we clear about why small businesses get the exemptions? Any doubt? Okay. Often the same people. Okay. Advice value which account can add to the small business, so very more likely to concern other services such as accounting and tax. So value added is not that big. Misstatement in financial statement of small companies unlikely to be material for wider economy. So in small businesses it's not very impactful for the entire economy. Okay. And audit fee and disruption basically irritates everybody. Okay. Now who may act auditor? No, nothing is illogical. Yes, nothing is illogical. As long as you have a doubt, everything is valid. See, question is never illogical. Okay, just try to think in the same sense. That's first one. Which first point, Aditya? Which first point? In this slide, in this legal requirement slide. Text point not clear. The owner manager here in this case. Yep. You're right now referring now? Okay. The owner and manager of the company are often same people. The advice and value of which accountant can add more likely. Okay, okay. So basically this is text point is basically for the government authority. Government collects tax now, so they want to know whether you're reporting the correct revenue. If you're not reporting or basically understating your revenue, so government would lose on taxes. So definitely enforcing the law, enforcing the audit on small company definitely benefits the government, basically saving them the taxes. But the entire point is how much value it adds. How much value it adds. Let's say, as I mentioned here, like let's say it's 100K earning and it's 30K expenses for the audit. So what do you think that that would not discourage the businesses itself? And let's say if you able to increase it to 20K, you were able to make it 20K. So government would be earning 20K into certain percentage of tax, that much of money. But do you think that justifies this 30K cost? So that is the entire point of this. Okay, I hope everyone is clear about it. I think Dinesh also said one point I missed it. Sorry guys, in case I missed your point, so please let me know if I'm not sure. Like, yes, I need to perform audit support as well as operational activity in entity. Okay, okay, Dinesh, you are actually sharing your experience. Okay, who may act as an auditor? As I told you, an ACCA qualified. Now, who can be considered an ACCA qualified? Please understand, this is important. ACCA qualified would be who has passed all the 13 exams or sorry, plus. He has passed all the 30 exam. He has PR, 3 years of PR requirement, and he has done his, he or she's, sorry about this. The person has done the PR requirement, the person has completed 13 exams, and they have done the ethical module. So once you complete that, then you become ACCA member, and then you would be basically recognized as a member. So please understand, only a member can do the audit. And once you do that, so you would be allowed to conduct the audit. Yeah, ethical module. Okay, so these are requirement. And in case of India, let me just quickly explain. This is a CA who is in practice. I hope I don't need to explain this. CA with a certificate of practice can basically conduct the audit, but CA of India can do the audit of Indian entities only. Okay, if he goes to the UK, so he may not be eligible. And similarly, a person of UK ACCA or ICAEW, if I remember correctly, ICAEW member can do the audit of UK companies. And if they come to the India, so they are not eligible for conducting the audit. Okay, only CA in India can do the audit. Only ACCA or ICAEW can do the audit of UK. Okay, so basically recognized supervised body of the nation can basically member of the recognized supervising body. So ACCA are the basically recognized body of ACCA global. Okay, so we are recognized member of that, and then we'll be eligible. Or someone directly authorized by state. State means government. So if somebody is directly authorized by this government, okay, so they would be like I don't know the case for UK, but I know that CAG, Computer Auditor General, for the in case of India, it's CAG that is authorized by the state. Okay, who may act as an auditor? Anyone knows the state authority, like who does the audit for the UK? I don't remember actually. I'm not able to recall it right now. Okay, no worries. I'll try to look at you. Okay, how can you do the audit work? You can basically solely, like as an individual, do your practice. As a partnership firm, like couple of individuals coming together and forming a partnership. And then there's a limited liability partnership. The only difference between partnership and limited liability partnership is that there is a separate legal entity. So it has same benefit as of a company. Okay. So limited liability partnership would be, like LLPs. So many companies in India, after like LLP Act introduced, got introduced in India very late, but I think it is in UK for a very long time. So any partnership firm registered as a LLP, limited liability partnership firm, would also be eligible. And this is basically only for UK. In India, it's not possible. You cannot, register yourself as a company and act as an auditor. So this is a called LLC, limited liability company. And I think EY, if I'm not correct, if I'm not wrong, EY, KPMG, or Deloitte, all these firms are LLC. Otherwise, they are LLP. I have not, read their financial statement. So if I remember correctly, I was reading that EY or KPMG, they are LLC, basically in their US. Okay, they are LLP. I'm not talking about India. India, they are, practicing with a affiliated firm. I'm talking about in their own country, like US based, not India, not India. Because, there is a Bartley boy that basically, does the audit. LLC, yeah, PwC is an LLC. Yeah, yeah, yeah. Okay, okay. No, no, Indian firms are LLP. In India, LLP was introduced very late, and then basically every firm basically registered themselves as an LLP because there is a benefit of limited liability. Okay. So please, this is the way you can do the auditing. And to be eligible, basically eligible to offer audit services, a firm must be controlled by the member of, so controlled by basically ACCA controls you here. So supervising body, and firm directly authorized by the state. Okay, so granting power of audit to government. So local body will be granting you the power. Now, there are exceptions who may not act auditor. Like now, this is would be the case where like you cannot audit yourself, or you cannot audit your relative. Like a son cannot audit his father's company. Father's company. Okay. A son cannot audit his father's company because there's a direct conflict of interest. Let's say if son finds a fraud in his father's company, do you think he would report it? Right? This is called self-interest, conflict of interest, self-interest or conflict of interest. He has an interest for his father, right? But Swayam, why do you think he would be honest? Don't you think that there's a human, we are humans, not robots, right? We are humans, so we always have this biasness towards each other. So no matter how much you claim that you are honest, how much you claim that you have standards, there's some emotional attachment always. And let's say even if you practice now, nobody would believe you. So why would you want to go there? So that's why law, stated simply, let's not go into this debate of whether we can prove it or not. Let's simply say that relatives or ourselves, we cannot do the audit. We cannot audit ourselves. First of all, if we prepare the financial statement, we do not audit ourselves. This is the first rule. So management can never give itself a independent audit. Okay, please understand. Management can never give itself a independent audit, though it can give itself an internal audit. Yeah, yeah, yeah. Big Four basically they audit each other. They audit each other. Big Four, in case of Big Four, rightly said Ganesh, they audit each other. So because they are the auditor. So even ACCA gets audited. Can you tell me the name? Okay, I forgot the name itself. I think it is Deloitte. I think if I remember correctly, Deloitte is auditing the ACCA. ACCA also gets audited. Deloitte. Yeah, yeah, yes, that's Deloitte. Global pieces. Global ACCA or PCC. Okay, so lawyer basically requires you where there's a conflict of interest. So lawyer specifically said ex-employees is not eligible unless there's a cooling off period. Please understand, it's a very it can be asked in the exam. Let's say you are a director of the company, okay, and you left the company 2 years ago. So now you join an audit firm. Do you think you should be eligible now to do the audit of the company? Everyone, I have asked you a question that you were the director of the company, okay, and basically You have left the company now and joined an audit firm. Now this audit firm is basically doing the audit of this company. Yep, 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 yep. So you can do the audit. They say, okay, it's not like you cannot do the audit, but you have to wait for a cooling off period. Now, cooling off period can be 3 year, 5 year, depends. So what is reasonable period of time? What is reasonable period of time would be decided by the would be decided by the government, or basically national law. Okay. Now, excluded by codes of ethics, auditor must also comply with the codes of ethics. If codes of ethics requirement, prevent auditor from acting, then basically you should not act as an auditor. Now, this is something that we would be covering in the ethics chapter. We'll be covering it detail. Like, ethics require you that you do not, there is no self-review threat, there is no self-interest threat. Should I discuss it now? No, let's leave it. Let's leave it because this is a very detailed topic and I don't think we have much time. So if I start this topic and I leave it in between, so that would be, very disheartening. Because if a good concept starts, then I want it to get completed within the class. So let's leave it. Just think that we'll be covering the ethics part. The ethics part will be covered in the chapter, like chapter number 5. Okay. So we'll be covering there, and this is very detailed. Okay. Any question till now? Just a moment. Okay, okay, nice. Now, what are your rights? You as future ACCS, what are your rights? It's you guys, my future ACCS. I'm not very good at drawing. Okay, what are your rights? So, I hope somebody find it, now. Okay, that's good if it has motivated you. Okay, let's read your rights. Okay, so you are going to audit the company. What if management says no, you cannot access this books of account? You feel you want to check the investments, or you want to check the inventory. What if management say no, please don't check it, check other things but not this? Sure, Divya, sure. Actually, on my LinkedIn I have given a very detailed post. Okay, so please understand that in order to you acting as a professional, you need some rights, you need some power. The point that I was trying to make, that you need to have some power. What if management prevents you? Okay, what if management stops you? So this is why you need the right to have an access to all books of accounts. If it's related to financial statement, then you must have right to those. Okay, you need to have power to receive information and explanation. Let's say you ask questions to management and if they deny, so the law grants you this power. As an auditor, if you remember my first, the person who was caring with the auditor, please understand auditor has so much power. And as famously Uncle Ben said in Spider-Man movie, that with great power comes great responsibility. So your responsibility is very great. Okay, you have great power but great responsibility as well. Please understand, auditing is no joke. You are, trying to tell whether something is truth or something is, lie. And that requires a lot of power, and that basically impose lot of onerous, lot of, responsibilities, because that will affect entire economy. So this is why you have been given access to, access the books of accounts. You can basically ask any explanation that is, you find relevant. And you can ask management, okay, give us this explanation, that let's say you have fixed, you taken the loan and you have further invested it. Why? Whether is there a routing, window dressing? You can ask these questions from management. Okay. You have a right to, attend the general meeting, so that you can make representation. Let's say you make certain audit observations which management don't like, and then they say, okay, we will not include them in our, annual report, in our financial statement. So you have a right to, go to the shareholders and tell them that what has happened. So you have a right to make representation to shareholders directly, because I'll be discussing like who appoint the auditor. So shareholders are the one who basically appoint the auditor. So if shareholders appoint you, so that is why you have a right to speak to them. Okay, so this is your right to speak to the shareholders. So attending general meeting basically meaning that you can go to the general meeting and, have your say in your general meeting. So to be heard. So you will have, you not only you will be present in the general meeting, you will also be there to, make your representation related to the concern of the auditor. So you would be representing your matter. It's not like you are going to, preach them about how should the company go. No, that is not your position, and that is not something that you should never do. But you will only, speak on the matter that concerns the audit. Okay. And you have any right to receive any return resolutions. I hope we understand that there is a board resolution, there is a, general meeting resolution. Okay, AGM resolutions. I hope we understand these, all these board resolutions and general meeting resolutions. Anybody who wants me to explain this? Like whenever you need to make decisions in a company that require, significant approval. So you have board resolutions where, number of board member participating with each other and voting them. And then basically then there's similar process that happens at the shareholder level. This is basically requiring some significant decisions. So you can get the copies of those. Anyone have any doubt about this? Okay. And this one is very important. Statement of circumstances. This is called circumstances, or in case, you resign. Let's say in any case you find that management is not very cooperative, they are not helping you accessing any books, they are not, giving you any explanation, they are not letting you, represent your matter. So you resign. And this is also one of your rights, to resign. You can resign. You can say, okay, I don't like this company, they are not, helping me do my work, they are not letting me fulfilling my responsibilities. So in case you resign now, every auditor basically gives a statement of circumstances telling why they resign. And it's such a powerful tool. Now let's say if a management is involved in fraud and they are not letting, auditor check the things, so auditor can resign and say this to the shareholder, to the public in large, that see, I was trying to check the information but they did not let me. And now shareholder will, ask questions from directors, the regulators, the government officers will basically come and start questioning the management, like what is going on. So it's a very powerful tool. So if a auditor resigns now, everybody starts panicking. And can anyone tell me, like recently there is a very famous resignation of an auditor. Like I'm not sure like how much do you read financial news, but there recently there has been a very famous resignation. Anyone tell me? This has happened in India. This has happened in India. Yeah, this has happened, Navi, but this is little old. This is little old. Okay, everybody's starting. No, recently, like couple of days back, just couple of weeks back. Okay, okay. You guys are mentioning one case about, buy juice, which is basically, yeah, I think Mehak, you know which one I'm referring. So Byju's, basically, which was, audited by the Deloitte. So you guys are referring, but I think this is, months back. This is an old one. Recently, Deloitte has resigned from Mr. Adani ports. And this is one of the, very major, one of the very important financial uh, event, like in last couple of years. Like one of the largest auditing firm. It is considered, one of the best auditing firm, like number one in the world. And they have resigned your audit. Tell us why. What is wrong? The explanation that Deloitte team has given is like, there have been recently so many news, and I'll not get into that, what is right, what is wrong. But the explanation Deloitte team has given is that we are trying to, verify the information related to, valuation of the company. We are not sure about the valuation of the company. So they have asked the Adani group that they should get, a third party to, get them valued. And this is one of the most important concept in our audit. We'll be covering it later, but this is something that I want to tell you. So Deloitte group basically asked the Adani group to, get themselves verified for valuation. But Adani group said, no, we will not do this. Deloitte group basically, asked them for valuation for the, recent news of Hindenburg. That because there is, doubt about the value the company is representing. So that's why Deloitte is not sure whether, they are not sure about the accuracy of the value. So that's why they wanted to, get verified. Otherwise, they would not be able to, provide a correct opinion. Why? Because they are not able to obtain sufficient and appropriate evidences. They are not able to obtain sufficient and appropriate evidences. And since that they are not able to obtain sufficient and appropriate evidences, so they are not sure whether financial statement are free from material misstatement. So in this case, instead of giving true and fair view, they said, okay, we are resigning. And this is one of the rights of the auditor. Clear everyone about this case? Okay. My only purpose for this example is to explain you. Even in the case of Byju's, this has similar happened, that they find so many financial irregularities and they were not able to verify them, and they were not able to verify the data. So that's why they said, okay, we are not able to conduct audit in the manner we want to do, and that's why we are resigning. And this is one of the most important right of the auditor, and they have to explain the circumstances regarding the cases. And that's basically, alerts everybody around it. Like it alerts the, stakeholders like shareholder, the suppliers, the bankers, the government. So it alerts everybody. Clear about auditors, right? And these circumstances, when they basically issue these circumstances, they basically have the right to get them circulated means to the shareholder, that once directors get their the annual report to the shareholder, because they share the annual report to the shareholder, so they can get it circulated to the shareholder. So along with the annual report, the company is by law required to get them these circumstances statement to the shareholders. This is compulsory. So circulation is clear, I hope. Clear, guys? This about the rights. Okay, and this is very small piece about the auditor, that uh, I have just told you that as an auditor, your responsibility is to check work of management. So management has a responsibility in terms of preparing financial statement as per applicable FRF. Correct? Are we clear till now that it is management responsibility preparing financial statement, complying with IFRS or IAS, whatever is applicable to them, right? This is management responsibility. Auditor only verifies this. This is the auditor's responsibility. Verification is auditor's responsibility. Correct? So if you read this, Financial statement are properly prepared, adequate, records, and basically they have sufficient records that auditor can check that the financial statement are, as per the books of accounts. You have prepared your ledgers, trial balances, and they are complying with the financial statement. This other information is basically annual report. We'll discuss them later, like when we'll be covering the chapter number 20. So when we say other information, this is basically something which is for annual report, and I'll not be able to explain it right now. And disclosure of director benefits like their salary and bonuses. So specifically in the financial statement, we disclose the information related to director salary and bonuses. So whatever benefit is given to director is disclosed in the financial statement, specifically what are benefits given to the director. So this all responsibility are of management. Auditor responsibility is for confirmation and verifying them. Clear? Whatever you're doing now, maintaining adequate record, maintaining the financial statement, agree to the books, and then there's other information that there's a proper disclosure of direct benefits, right? These are these all are responsibility of management. Auditor's responsibility is to check them and verify them. Clear? Okay, this is auditor's duty. And not even in UK, any company law, basically, this is a general principle, but it has been specifically given that it is an offense, punishable offense. You would be jailed or basically fined for recklessly making a statement. So you cannot make an irresponsible statement. And irresponsible means even by error, including error, mistake, that you have not checked something, you have not, you were supposed to check and you did not check it. So it would be considered irresponsible behavior, and that would be basically considered to be a reckless misstatement, and that would be offense. Okay, so your mistakes are not allowed unless they are genuine. Okay, so this was auditor's duties. Can we continue for 10 minutes or should we wrap up the class today? Just asking, because these are some small concepts. Or everyone comfortable? Just 10 minutes, just 10 minutes. I know I have stretched the time, but because we are in a good rhythm, that's why I'm asking. No, it will not. But yeah, it would, because the important chapter, important component of the chapter, like who appoint the auditor. Sorry, we have IFAC body to cover, IFAC body and other things to cover. But yeah, right now we are in a good rhythm, and this is actually the flow. Resigning. This is all, this is the very small portion, but I think we can cover this portion. Just these 3-4 slides. Okay. Sure, na? Okay. Thank you everyone for, just 10 minutes, just 10 minutes. Okay. Who appoint the auditor? Auditor is appointed by the shareholder. Appointed by the shareholders. So shareholder are the people, basically the people who own the company. Okay. So they are the people who basically hires the auditor in the annual general meeting. But please understand, first auditor will be appointed by the director, or in case, let's say, auditor resigns. Auditor resigns. So that basically, create a vacancy. We look for the vacancy, we look for jobs. So that creates a vacancy in auditors. So it's called casual vacancy because it has happened during the year. So auditor was appointed during the, EGM during the starting of the year, and then auditor started auditing, but he resigned for some reason. So our directors can fulfill the vacancy, but it needs to be, approved later on by shareholder. So shareholder, let's say, during the year, or directors appoint one auditor, then during at the end of the year, in the at the time of annual general meeting, so shareholders will be approving whether director's appointment was valid or not. It's not like director can take anyone and basically shareholder will have to accept it. No. Shareholder will only approve. Once a shareholder approve, only then that will be validated. Otherwise, if shareholder does not approve it, then the appointment of that auditor will be invalid. Okay. So director first, either the first auditor, let's say company gets open, and because company can, there's a Jan to December period, let's say. So company can open like in the month of October. So right now there is no AGM. AGM happens at the end of the year. Okay, end of year. So in the month of October, the first auditor will be appointed by the director. Similarly, in case during this period auditor resigns, so casual vacancy will be filled by the directors, which basically later on approved by the shareholders. I hope this is clear. In case no auditor is appointed, like let's say director failed to appoint the auditor, let's say in case if after the resignation, like in case of Baiju, and the auditor resigns, and now Baiju is not able to obtain any auditor, so basically the state, the government basically appoints the auditor for them. Like depends on the law to law, but here Secretary of State basically means the government authority of the UK. Okay, auditor must be appointed each financial year. So let's say 2016, 2017, 18, 20, 21, 23, 22. So each year auditor will be appointed. So it's not like auditor gets appointed one time and then it will be auditor for entire life. No, auditor gets appointed each year. Okay. So in case of public company, from one AGM to next one. So AGM can happen within 1 year or 1.5 years. So normally they happen within 1 year. So that's why it's basically assumed that from one AGM to next AGM, auditor gets appointed. Clear? Any doubt till now? Any doubt, anyone? I think my speed is little fast, but I hope these points are simple to understand. I know my speed is little fast today. It's fine? Okay. And any doubt so far? Any student facing any doubt? Everything is clear now, because this is very easy. That's why I thought it's better to complete it. Okay. Thanks for confirmation. Okay. Removing the auditor. Now, it's not like that it's only the right of the auditor. They are also, under some regulations. Like auditor can be removed. Let's say what if auditor is not behaving professionally? Or it can be a case where management is doing some fraud and they don't want auditor to get into the details, so they fire the auditor on the grounds that on some invalid grounds, fire the auditor on some invalid grounds. So they say no, he's a bad auditor, he or she is a bad auditor, let's remove them, they are not doing any good for our business. So if that is the case now, then basically your statement of circumstances will help, and your right to attend the general meeting and your representation in the general meeting. So this at that time will help. So you can be removed for a valid reason or for an invalid reason. In both cases, you would be given a chance to represent your matter, a statement of circumstances. Okay. So usually achieved by simple majority at general meeting. So if shareholders are not happy with the auditor, let's say they feel that the auditor is favoring the management, so they can remove the auditor in the annual general meeting. And as we know, auditor is appointed each year. So that's why that is the reason that if shareholders are not happy with the auditor, so they can remove the auditor and get a new auditor appointed. However, there are some safeguards to the auditor. Like it's not like you can fire the auditor right away. Audit is a very big responsibility and it's a very big power. So that's why there are some safeguards, and safeguards are all safeguards are on basically on reasonable grounds. What are those reasonable grounds? Let's discuss them. Such as specified notice period. There should be an advance notice period, like in case of depending upon the country, like 15 days notice period or 21 days notice period before firing them. Like you have to call a general meeting and you have to give them a notice that this is a 15 days or 21 days notice period, and we basically have convened this meeting only for the purpose of firing. And in this case, auditor can give the circumstances, statement of circumstances, and get them circulated to each shareholder so that he can make his representation, that when the shareholder comes, they know auditor side as well. Okay. circulate the representative statement why he should not be removed. He can say what is the ground that basically he should not be removed. Okay. And statement of circumstances, company and regulatory authorities, it is not only sent to the shareholder but also to the government authorities. Okay, so in case of India, it is registrar of the company, but in case of Companies Act of the UK, we have to see like whether it's a state of a secretary or where we have to, uh, share this information. So it would be, regulatory authority, like most likely it's going to be state of secretary in case of UK. So arrangement of removing the auditor have to be structured in such a way that auditor has sufficient secure tenure of office to maintain independence. An auditor can be removed if there are doubts about their condition ability to carry out their duty effectively. If there is a doubt that auditor is not independent, let's say auditor turns out to be the relative of the director, or basically is saying that arrangement of removing the auditor have to be structured in such a way that auditor has sufficient secure tenure to office to maintain independence of management. So basically it's saying auditor should be independent if hold the office. In case you remove them. So basically they have a secure tenure. What I understand is secure tenure should not be discussed right now. Secure tenure is basically, you have a tenure of 5 years and each year you get appointed. Okay, each year. Like an auditor cannot be appointed like more than 5 or 7 years, depending upon the country. So when you say that if it is a secure tenure of 5 years, so it should maintain the independence. That I'm right now confused, like why they are discussing right now. Okay, cool. No worries, no worries. We'll discuss this point. Okay, leave it for later. Don't worry, we'll discuss this because it will actually create for new topics. So we are already running out of time. So let's leave it here. And I hope, except this point, I hope rest is clear. Okay, everyone, I have taken my 10 minutes. I know there is a remuneration and resignation, but don't worry, we'll cover it later on. A very small portion of this chapter, and then in next class we'll be starting with the chapter number 3. We are currently going with the flow of the book. We'll be covering the corporate governance, and it is one of the most fundamental of the chapter, though you would not realize it when you are reading, but once the chapter is completed and we are in the process of risk assessment and all that, then you would be realizing that actually the corporate governance is a very fundamental chapter for the purpose of audit. But in case you already know what is basically the significance of agency issue, what is management's responsibility, what is audit committee, and the what are their functions, if you know them, then you already know the fundamentals. But otherwise it's a very good chapter from the point of view of management. And the thing about that chapter would be that we would be reading it from the point of view of management, and it would be very hard to recall that we are auditors. Okay, sorry to keep keep stretching the class. Thank you, everyone. Thanks for your time. Thanks for tolerating my stretching time. Thank you so much. And please let me know, the feedback in case you want to give me any feedback, like my speed, or basically you want me to explain. Yeah, definitely, these notes only are only for you only, right? This is for you only. Okay, please let me know in case you want me to give me any feedback. And also please do the homework questions. I hope you remember the questions that I have given you. In case you want, I will be giving you again. Okay, 1 3 4, and then this was 31 32 33 35. Okay, please do the questions. And this was 213 and 216 217. Okay, please do the questions. Yeah, sure. Questions are let me just give you the list. Questions are 1 3 4, because this is a 5 questions series, but you would not be able to do the 2 and 5 question. If you try, if you can, but if you can, then that's a very good thing. But question number 1 3 4 is mandatory, and similarly 31 to 35 is a set of questions, but you would not be able to do the 34 question number 34. So if you can try to do it, the question that 34 is, you can skip here, or 2 and 5 you can skip here, but try to do if you can. And then there is 213a, only part A, 215 and 216. This is for chapter number 1. Yeah, sure, sure. Okay, thanks everyone. Please let me know in case of any doubt. If there's a doubt, so we can continue the class. Otherwise, let's wrap it up. Any doubt, anyone? Or should we wrap it up? Okay, yeah, I'll ask in the group, Mushkish. I'll ask them in the group, like share the notes so that it becomes easy for you, right? So thanks everyone. Thank you. Yeah, you too. Everyone, please take care. Have a great weekend and please study. This is important. Please study. Okay. Bye bye. Good night. Good night, Yash. Bye, Aditya. Bye bye, Mehak. Bye, Divya. Bye bye. Bye bye. Bye. शुभ रात्रि. चलो थोड़ा बहुत हिंदी बोल ही लेते हैं लास्ट में आके. Okay. Good night, everyone.